Ernest Bodziuk, dzień dobry. Szanowni
Hi, this is Ernest Bodziuk speaking. That's the second day of the Warsaw Passive Investment Conference. Our agenda is going to last to 2 p.m. A wide range of interesting speeches. This is something that we are planning on for you. First, economic outlook for 2022, equities, commodities, and themes. Anita Kojima and Anika Gupta of Wisdom Tree are our guests in this part. All to be moderated by Karol Szymański from the mBank.
Hi, hello. My name is Kamil Szymański from mBank Brokerage, and I wanted to welcome everyone to the next panel where we're going to discuss the market outlook with Wisdom Tree. Anita, I wanted to welcome you to this year's Warsaw Passive Investment Conference. Wanted to welcome you on behalf of all the organizers, including the Warsaw Stock Exchange. We're really happy to have you here for various different reasons, but one of them is that you are popular amongst investors in Poland. Having looked at some rough figures, some basic figures, at mBank alone, since the start of the pandemic, over 10,000 clients purchased one of your products at some point. And if we add to that you're an unquestionable leader in the space of commodities, we're really looking forward to today's presentation. And Anika, I will hand over to you now. Thank you.
Thank you very much, Camille. A very good morning to you all from Wisdom Tree. My name is Annika, and I look at commodities and equities at Wisdom Tree. So I'll start with a brief presentation on equities, what our outlook is on equities in 2022. And after that, I'll give you a brief outlook on what we are actually seeing in the commodity market. So just moving over to the very first slide. We've just seen, the recent downgrade by IMF on growth expectations for advanced economies, and a lot of that has been predicated on, the rise in inflation. Some of that has been owing to a carried over effect in 2021, and a bit of that is also due to headwinds that we're seeing from the war in Ukraine that is currently taking place, that has actually given rise to higher energy prices, which is feeding into much higher inflation, and at the same time is eroding investor confidence. So just moving over to the next slide, I thought it was worth illustrating to you what we're seeing in the US. Right now, consumer prices in the US have hit an all-time high. They've reached the highest level since 1980. And this is both across consumer prices, the change in CPI, the broad-based change in CPI, including core CPI, which is which is trending quite close in this rapid uptrend that we're seeing in CPI levels. So just looking at the next slide. What we see here is, if you look at employment levels in the US, we've got a very hot labor market in the US. Wages have been rising, and that is one of the key factors that is playing into the higher inflation prints, which is why the Federal Reserve has, started in 2022 on a much more hawkish monetary policy front, owing to which, we are now expecting quite an aggressive number of rate hikes, during which we're going to see a much larger magnitude of rate hikes priced in. And when I allude to that, I mean we're looking at around 200 basis points of rate hikes in the US alone. And this much more hawkish monetary policy is warranted given the fact that the U.S. market is, the U.S. labor market is doing very well, and energy prices are high, but they're not actually impacting, the U.S. market as much. So the key question is, are we actually at peak inflation levels at this point? For us, we don't believe we've reached peak inflation levels. In fact, we believe, given the fact that PPI is so much higher than CPI levels at this point, we believe that catch up for CPI to the PPI levels is still going to take place. Just moving over to the next slide. So many investors right now are actually questioning, looking at where the S&P 500's performance has been in 2022, we have seen quite an aggressive sell-off. But if you look at equity risk premiums, which essentially illustrates the advantage of equities over bonds, you still see quite a strong advantage on equity pricing versus bonds. So equities still hold a very strong benefit in these current markets. Just moving to the next slide. Um, you know, Earnings are always the key drivers of equity market performance, and it's been quite a tug of war between the US and Europe. 2021, Europe was actually outpacing US in terms of earnings revisions. And actually, when we started the year in 2022, Europe was outpacing the US in terms of earnings revisions. A lot of that was due to the positive momentum coming out of the Omicron variant for Europe. But ever since we've had, the Russian war on Ukraine, that has changed sentiment quite a bit. And we're now seeing earnings revisions that were previously dipping into negative territory for the US, actually now trending just around the 0% level, while Europe is actually doing much worse. So just moving over to the next slide. Now, if you look at economic surprises, you'll see a very interesting trend. Over the course of 2021, for a significant period of 2021, Europe's economic surprises were actually doing quite well on the upside. So much so they were actually outperforming the US. But as we've come into 2022, post this unknown situation that the markets were not ready for, the Russian war in Ukraine, train of events has changed quite drastically, and now the US economic surprises are actually outpacing those of Europe. So just moving over to the next slide. And moving over to more economic data in Europe, first and foremost, forward-looking indicators such as the purchasing manager indices, be it for manufacturing, services, and the composite indices. What we're starting to see is, these levels are now starting to moderate after, a sharp bounce back in 2021. After the sequence of events that we've seen in 2022, we're starting to see a bit of moderation. Just moving over to the next slide. And what you see now is one of the chief reasons behind that. There's been a massive energy shock that has taken European markets by surprise. I mean, take to account the news that we've been receiving. Russia has now actually mentioned that those unfriendly nations that are not willing to pay, for energy in rubles from Russia, they're actually going to discontinue supply to those very countries. And that is another very important threat. And the reason, and the thing that's most unfortunate is, given Europe's high dependence on energy from Russia, it is actually most exposed to this war taking place in Ukraine. And so, just if you look at the very next slide, what you actually see here is, confidence in Europe is now starting to dip. We've had a strong resurgence after the, COVID pandemic, and 2021 has been a fantastic year. But just as we've opened 2022, we've had this energy shock that is, feeding into industry, and we're now starting to see that impact consumer confidence. And, what you'll see in the next slide is that the ECB has very quickly had to turn around its story. You see, because when we started 2022, the consensus was that we wouldn't be seeing an interest rate hike in from Europe. In fact, it was all priced in for the US. But what's happened in 2022 is that the Fed has become even more hawkish on its monetary policy, And Europe has had to really pick up from base level, and we're looking at asset purchase program ending by the first quarter of 2022. We're also now pricing in virtually 3 rate hikes for 2022 by the ECB, given the fact that we've had such a resurgence of inflation, which has really been emanating from energy prices. And the unfortunate thing is, since we do not have an end date to this war, and there's so much of uncertainty, given the fact that we have this event taking place. It's very difficult for the ECB to actually price in when energy prices are going to start to normalize. And what you see in the next slide is quite interesting, because um, the important thing for Europe, one of the main advantages that Europe had in 2022 over the US was that US earnings were likely to come under pressure because of the significant rise in wages. While Europe had seen a bit more of a tepid rise in wages compared to the US, and hence operating margins were more easy to maintain in the European market. But now what's happening is, uh, that the wage pressure is still not as high as we've seen in the US. But the fact that we are seeing higher energy prices, higher input costs, that is likely to feed into into the inflation narrative, and could suppress operating margins going forward. And just moving over to the next slide. I thought a very important slide to put forward. It really summarizes where investors should actually seek shelter. As we've seen so much of volatility come back into the markets, this slide says it all. What we've tried to do here is we've tried to slice up factor performances across global equity markets, and two factors that really have been shining in 2022, and we believe there's further room for these two factors to outperform in 2022, are the dividend factor and the value factor. And you see, the reason is because these two factors are very strongly tilted towards sectors that are trading at a discount, sectors that are price makers versus price takers. So they're the sectors that have that command over the market, that even if prices, input costs arise, even if wage pressures are there, these particular companies in these sectors have the ability to maintain those margins. And so they'll just be passing over the price rise to the consumer. So that's a very important factor to look out for. Which are those price takers in the market? And those companies generally tend to be in the high dividend, high value factors. And obviously, the third very important reason is companies that are paying out higher dividends, alongside the fact that they have a good dividend cover, are those companies that investors want to take shelter from, because in this rising rate environment, given the hawkish tilt that we've seen from the Fed, this is the best place for investors to actually seek shelter from, because you get a bit of insulation by earning that higher dividend yield. So just moving over to the next slide, I've talked a lot about the advanced economies. I've mentioned the US, I've mentioned Europe, and clearly what's very, very eminent is monetary policy is likely to be a lot more hawkish in the developed market world, given this inflationary shock that we are starting to see. But it's very interesting to pause for a minute and look at what's happening in emerging markets. And clearly, we see four very important factors that could bolster the outlook for emerging markets in 2022. Now, these four factors really are a weaker US dollar over the long term, higher inflation, which is emanating from higher commodity prices. The third very important factor is attractive valuations. Let's not forget, in 2021 and 2022, European and US markets and global, developed markets were overpriced. Emerging markets, on the other hand, have been trading at a discount. And then monetary policy. I've talked a lot about the fact that the US and Europe have a much more hawkish tilt to monetary policy. In comparison, China is, on a completely different path. They are looking at stimulating the economy. They are looking at a looser monetary policy and a much more accommodative stance to monetary policy. And so these four factors, we believe, will be important tailwinds for the emerging market arena. So just moving over to the next slide, a very important factor that you see in this slide is illustrating China's contribution to financing growth. And as you can see, over the course after the second quarter of 2020, China was one of the first economies to actually bounce back from the COVID pandemic. But since then, they had a very important focus of cracking down on sectors of the economy that were using leverage without any restraints. And so we saw a big crackdown on the property sector. Now, that obviously led to a lot of pain. That we've seen a number of the real estate developers come under a lot of duress in 2021. But as we've opened 2022, the entire stance by the PBOC and the government has changed, and it's really about targeting and reinvigorating that growth back into the economy. And don't forget, this is coming at a time when COVID cases are rising in China and Hong Kong. This is coming at a time when because of these COVID cases rising and China's zero COVID policy, we're having a lot of supply bottlenecks that are impacting the economy. And in addition, China is also trying to maintain a common prosperity initiative by the government. And in light of those events, China is definitely now trying to stimulate the economy. So you're looking at China's contribution to financing growth rebound for 2 quarters in a row. And that is a very important factor because historically, when you see China's financing growth rebound in lockstep, you start to see China's local A shares actually start to outperform. So just moving over to the next slide. So a very important factor you're looking at here is inflation. Now, inflation is less of a problem in China. CPI last year, we had the CPI and PPI gap quite wide, and hence there was fear that CPI would catch up to PPI and there would be no room to accommodate for the Chinese PBOC. But actually in 2021, we've seen that gap start to narrow, and the widening of PPI has come down, CPI is plateauing, so that gap is narrowing, which is giving the PBOC more room to actually accommodate. So just moving over to the next slide. What we see here is, yes, emerging markets have, if you look at forward-looking indicators, over the course of 2020 and 2021, they've maintained, purchasing managers indices have been trading above the 50 expansionary mark. But as we moved into 2022, we've seen a dip. But there is still very important factors, going for emerging markets, as you can see in the next slide. So what you see here is exports for emerging markets are trading higher. They've maintained their momentum in 2021. They continue to maintain their momentum in 2022. And that's a very important factor for emerging markets because exports are one of the key drivers for emerging market economies. Just moving over to the next slide. But what is even more important for emerging markets are what are those terms of trade that they are commanding on these exports. And that's really interesting because if you look at Brazil, an economy that had been suffering last year, Brazil is actually outperforming this year, and its terms of trade are actually rising. So that's a factor that is benefiting. So not only are you seeing exports rise, you're seeing the terms of trade on these exports actually improve. And in the next slide, what you see is quite interesting because when the Fed starts to embark on its rate tightening cycle, everyone panics about emerging markets, right? Now this year, emerging markets, their balance of payment and their financial stability is much stronger than what we saw back in in the last rate tightening cycle in 2015. In fact, if you look at the balance of payments for emerging markets in this slide, highlighted by the yellow line, it's actually higher than the balance of payments for developed markets. So, key economies such as Latin America are starting to improve. Emea remains really strong. And in addition, Asia ex Japan also is really driving that improvement in the balance of payments. So that gives the emerging markets a lot more ammunition to withstand the rate tightening cycle this time around. So just moving over to the next slide. So what we see in this, in this slide is a very important factor, because whenever the dollar is strong, emerging markets get pressurized, as I mentioned before. But our view, as you can see in the next slide, is that we believe there's a very strong correlation between the trade deficit, as you can see in the next slide, and the actual performance of the US dollar. So we've tried to plot the trade deficit as a percentage of GDP, and compare that to the US dollar. And what you see is very interesting. So we've tried to lag the performance of the dollar by 3 years, and you see a very close correlation between the two. So as the trade deficit, as we've seen, we have twin deficits in the US. As this continues to become more and more negative, the trend for the US dollar also is likely to weaken. And that is the long term established trend for the US dollar. So, although in this short term volatility, we are seeing the dollar benefit and other economies actually suffer, over the long term, given the fact that the US has so much of debt, over the long term, the dollar's trajectory is likely to be weaker, which should again be another factor which should benefit emerging markets. I'll now move over to the next part of the presentation, which is really focusing on commodities. So, looking at the very first slide, what's really interesting here, extremely important phase in 2022. And this is really driven by four key factors. The first one being elevated inflation. Commodities generally serve as a very good hedge versus inflation. And as we see these very high inflation prints, commodities stand to benefit the most. The second very important thing is an infrastructure rebound. Let's not forget, coming out of the COVID pandemic, we have seen a lot of a lot of economies such as Europe, such as US, put forward some very important infrastructure plans to try to rebuild the economy. These infrastructure plans are very commodity intensive and are again another factor that are going to benefit the commodity markets. The third very important factor is the energy transition. Now, you know, today's the situation Europe finds itself in today is just so important to the theme of the energy transition, because I think no country would ever want to find itself as vulnerable as Europe finds itself today to Russia. And so the energy transition has become an even more important story today, given the situation we find ourselves with the war in Ukraine, Europe's vulnerability to Russian oil, and it's just making it even more important for Europe to actually build out this energy infrastructure to try to transition to cleaner and more renewable forms of energy. And all of that is again very commodity intensive, as we'll discuss in the slides ahead. And last but not the least, this is a new era of commodity investing. What's very interesting is, you're seeing, given the shortage of supply in a number of metals, you're seeing a number of commodity curves in backwardation. So today, when you are investing in these ETFs, you're actually getting paid to invest in these commodities, because when you invest in a commodity, you're getting three forms of return. You're getting your roll return, you're getting the spot return, and you're getting the collateral return. And most roll returns today are actually in positive territory, as we'll highlight in the slides ahead. So just moving over to the next slide, clearly, as we mentioned before, developed market economies are seeing a very, very high inflationary prints, and a lot of it is linked to the commodity cycle. As we've seen, commodities have been benefiting the most in this environment. Just moving over to the next slide. So we tried to do an analysis, and we've looked at environments where inflation was low and increasing, in previous cycles when inflation was high and decreasing, and those environments where inflation was high and increasing. And what we found, similar to the environment we're facing today, when inflation was actually high and increasing, the asset class that benefited the most was actually commodities. And this is another factor which is driving the performance of commodities today. Just moving over to the next slide. Another very important analysis that we had conducted was the actual movement of commodities to unexpected inflation actually had the highest beta to unexpected inflation. So we see the outperformance within broad commodities. They actually exhibited the highest positive beta to unexpected inflation, even more so to unexpected inflation. So today's environment, given the uncertainty of the war, given the uncertainty of how these sequence of events are going to play out, do open up that environment of unexpected inflation. And in that environment, commodities do stand to, hold a place in your portfolio. So just moving ahead. So, as I mentioned, the second very important factor that is driving commodity performance today is infrastructure led projects. And the most important factor driving this is a lot of these infrastructure led projects are very commodity intensive. Especially in Europe itself, we've seen a number of infrastructure projects that are, initiated on greener energy, on the transition energy, and again, those are going to be very, very commodity intensive as these projects actually get, put to fruition. Just moving ahead. We've tried to highlight this range of slides. So what you see on the top hand corner is the entire spectrum of the energy transition. So on the top hand corner, what you see is the different segments within the energy transition that will be that need to be built out in order for the energy transition to actually take place. But what you see on the left hand column is all of the commodities that would be needed to make these projects come to life. So be it electric vehicles, you see a very important use of aluminium, of copper, of stainless steel, of tin, and of zinc. And you can look at each of the individual energy transition projects, and you can see which of the commodities are most used. But the broad idea is all of these energy transition projects are very commodity intensive. So just moving ahead to the next slide. Interestingly, we had looked at this analysis by Bloomberg New Energy Finance, and it actually highlighted that in 2021, the global expected electric vehicle sales were less than the actual. So that's really interesting because number past the estimates, which highlights, how strong of a push that we're seeing in this direction of the energy transition. Just moving over to the next slide. So this is another very interesting slide that how commodity intensive the use of electric vehicles are going to be. So a typical conventional car that a lot of us still use requires much less of copper, manganese, and lithium. But as you move forward to an electric car, that requires a much higher and much more elevated use of these commodities. So you can see nearly triple the amount of copper being used, not only in the on the car, but also in the grid infrastructure, in the wiring in the car. You can see the use of manganese being amplified. You can see the use of zinc actually being increased, and various elements such as graphite also being increased to a large extent because of its use in the actual battery of these electric vehicles. So just moving ahead. last but not least, the very important factor that is really, opening up a very unusual part of the commodity super cycle is, what we're seeing today. What I'm currently trying to highlight in this slide is the number of commodities today that are in backwardation. So I'm looking at the 25 commodities that are used in the Bloomberg Commodity Index. And what you see is of those 25, you're looking at nearly 15 commodities in backwardation. Those commodities itself are yielding a positive roll yield. So by investing in those commodities, not only are you benefiting from the positive performance of the spot price, but you're also earning that roll yield, which is a very important factor. And just moving over to the next slide. Clearly, the war that is taking place between Russia and Ukraine has caused significant jitters in the commodity market. I've just tried to highlight, the proportion of world production that is coming from Russia, across a number of these commodities. Clearly, palladium is right up, on the right hand of the axis, with nearly 38% being sourced from Russia. The other very important one has been sunflower oil seed, and that's clearly been squeezing the oil seed markets in a very big way. Natural gas, again, very, very important for Europe, and that's why we've seen a very big jump in natural gas prices alongside crude oil. Wheat, Russia and Ukraine are very well known as the breadbasket for Europe. And this has consequences, as we saw a very large jump in wheat, as high as 73% between February and March. We also have seen corn respond in lockstep, and soybean markets actually respond in lockstep, as they have a ripple effect across the grains market. Last but not the least, moving to the last slide, Ukraine also a very, very important exporter and producer of corn, wheat, rapeseed, and barley, and clearly having a very, very important factor on commodity prices ever since we've seen this unfortunate war take place. And just moving over to the very last slide, as a consequence of this high inflationary environment that we've seen, the rising supply bottlenecks that have been emanating since, China has seen rising COVID cases, an immediate effect, and the energy transition that has been underway, we have seen an immediate response across the commodity landscape. And, the biggest jump has been in precious metals. The second biggest rise in commodity flows in the ETP market has really been in broad-based commodities. That's why investors have been seeking a lot of exposure to. And then, as you can see, agriculture, industrials, and energy has also seen a lot of interest. I like to end on that note and pass it back to Camille.
Thanks a lot, Anika. Thank you for the presentation. It's been excellent. I think it's getting increasingly difficult for investors around the world to try to work out what is going on in the markets. So this measured and holistic approach you've presented is very valuable, much appreciated. Inflation seems to be the name of the game, but likely there's quite a few other developments going on, like in mentioned broad commodity markets or those changes related to the energy transition. So thanks a lot for that. And so what we wanted to do now is to move on to Anita, and we'll spend about 15 minutes talking about ETFs and ETP markets specifically. Anita, last year, Theme of Stars was presenting at the Warsaw Passive Conference. I know Theme was still with WisdomTree, but this year it's you and Anika having the pleasure of representing WisdomTree. So Anita, if you could please tell us a few words about yourself, and then perhaps what the year WisdomTree had since I spoke with Timo last year during this conference.
Yes, sure. Thanks, Camille. So I'm part of the WisdomTree sales team who covers the German-speaking regions. So that's Germany, Austria, and Switzerland. And we also cover Poland. And just a bit background on WisdomTree. We are an ETF provider from the US, and when we came to Europe, we acquired Etf Securities, who were one of the leading innovators in commodities. They, for example, have launched the first physically backed gold ETC. So today, our clients benefit from one of the broadest range of commodities, including single commodity exposure, broad commodity baskets, and short and leveraged commodity ETPs. In the equity space, we are also known for our strong thematic offering, as well as smart beta products and innovative fixed income ETFs. And another focus area for us are crypto ETPs. So last year, we had a very busy year with a total of 12 product launches. And our best product launch was the carbon product, generating just over 220 million of net inflows since launch. We have also added to our broad commodity baskets range with 2 new products. One of them excludes agriculture and livestock, which is very popular in Germany because of ESG considerations. And the second one is a product, it's a broad commodity basket, but with physical replication of gold and silver. We have also increased our digital assets offering with 3 crypto baskets, which is particularly interesting for clients who don't want to bet everything on one cryptocurrency, but who want to diversify their crypto exposure and use crypto more as a thematic play in their portfolio. So overall, we had great results in industrial metals, and we also saw a lot of demand for growth strategies like thematic ETFs. And this year started with more inflows into commodities, and we have seen a shift of focus towards factors like quality and value, especially because of the current situation, including rate hikes, rising inflation, and geopolitical events.
Okay, thanks for that. And you've mentioned a lot of things happening, new product launches, and I think it's the same everywhere in Europe. Whether you look at the local market here in Warsaw, there's been new ETPs, new ETFs launched on the Warsaw Stock Exchange as well. When you look at Europe, I mean the landscape is incredible. I'm on a lot of newsletters sort of related to ETFs and ETPs, and every other day I receive an email about some exciting product launch or a new development. So I'm going to ask you a hard question, but I'll ask it nonetheless. If you were to pick the one single most important development in the ETF, ETP space in the last year, what would it be?
That's a good question. So over the last 1 year, the biggest theme from a product development perspective in European ETFs is still ESG. We saw ETF issuers are actively launching products providing deep green benchmark exposure, such as Paris-aligned on the equity side or green bonds on the fixed income side. From the thematic ESG space, ETF issuers are providing more products for investors to get exposure to the current and future decarbonization technologies, such as wind, solar, battery, hydrogen, or recycling themes. And besides the new product launches, we also saw ETF issuers are converting the existing products from non-ESG to ESG by moving the underlying indices from traditional benchmarks such as the S&P 500 to the S&P 500 ESG version. And from a sales perspective, I can only echo that trend. Clients demand more transparency, and they want the investments to provide value while still contributing to more sustainable societies.
Okay, the ESG theme has been here for quite a long time. So if you mentioned that still last year was the most important area of development, I think it's showing how significant, how important this area is. But I wanted to ask you the next question. The next 3 questions I wanted to ask you about other areas. And the first one is commodities. And you're obviously known for as an expert, a place to go to for commodities. And I can confirm when I look at our clients, at sales at mBank Brokerage, some of your commodity products are in the group of those super sellers, so ETPs that we have. And my question to you is, given how established you are in this commodity space and those products that you have, and given their popularity, do you still see this area as an area of growth? Do you plan any new product launches and any changes, any developments? Or perhaps you believe that it's worth moving on to other areas like thematics that you've mentioned, or putting more emphasis on ESG?
Mm-hmm. Yes, so WisdomTree holds a very strong position in commodity ETCs, but that doesn't mean that we just rest on our success in this area. We always review our product offering, and we will improve product features or launch new products that are timely and relevant. We appreciate client feedback, and we also partner with customers to launch products to solve specific investment needs that they have. One example of this is the broad commodity basket that excludes agriculture and livestock, which we launched last year, which was a request from a client. Also, an example of features enhancement is our physically backed gold ETCs. So in early 2020, we began addressing sustainability questions in our product range by replacing the gold bars for our physically backed gold ETCs with post-2012 gold bars, which is the current LBMA market standard for ethically sourced gold bars. As a background, the LBMA, so the London Metal and Bullion Association, it's a trade association that sets the criteria that enable the global trade in gold and silver bars. And the LBMA's responsible gold guidance was set up to combat money laundering, terrorist finance, and human rights abuses globally. And another example is our oil flagship product, GRAT. After the extreme volatility in the markets in 2020, we have moved to a multi-tenor index that invests into 3 different future contracts instead of one, making the product more secure. Our carbon product that I mentioned gives investors access to participate in the European Union Emissions Trading Scheme, which is the world's largest carbon market and the foundation of the European Union's policy to mitigate climate change and reduce greenhouse gas emissions. And lastly, there are also a lot of new products in the pipeline. Also recently, we have launched 2 new metal baskets designed to capture the demand and growth of specific metals involved in the energy transition technologies. And so this is more like a thematic play on a commodity basket, I would say. And here we have partnered with Wood Mackenzie, which is one of the leading energy transition research and consulting firms.
The ESG that you've mentioned, because you've mentioned ethically sourced gold when you talked about your gold products, and do you think we're moving from a time a few years ago where ESG was seen nearly as a separate theme? It was like a theme ESG, so you would have those products are not ESG, and this fund is ESG, is meeting some criteria, but we seem to be moving into an area where this ESG criteria are being applied to all types of products. So you've got and I've looked at some of your other products, not only your commodity products, and I've seen that to a lot of them, they're not called ESG ETF, but when you look at it, there's a lot of ESG criteria applied to it. Do you think we're moving from a time where ESG was seen as a separate theme, separate type of fund, to a place where ESG criteria would be applied to all of the funds? Like we now have usage funds that need to meet the usage criteria, and let's say in a few years' time, we would have all funds being, in one way or the other, ESG funds, whether it's commodity, whether it's equity funds, fixed income funds. They all will be expected to be sort of ethical ESG in one way or the other.
I think it's possible, yes. More and more clients that we're speaking to, they kind of request our funds to be ESG on the equity side. we get also more requests on the commodity side, and if we have an ESG approach there, which is at the moment a bit difficult, but yes, it's certainly going into a direction where every strategy, I think, needs to have an ESG filter or kind of provide access to that mega trend.
Okay. So speaking about mega trends, and you did mention themes as well, I wanted to ask you another tricky question. Thematic investments, that area has been developing incredibly fast over the last few years. And again, we're looking at the incredible amount of product launches, and some of the new products, when I look at them, I start thinking, is this still a theme? Is this still based on a mega trend, or is it something that just seems to be a bit popular at the moment? So, given the developments in this area, in your view, if you could name 2 or 3 themes that you believe will stand the test of time best, which themes do you believe still going to be relevant in 2, 3, 5 years time, or even longer?
Yes, so that's a bit of a tricky question, but I try my best. In general, in Europe, the AUM in thematic ETFs and open-ended funds stands at around $289 billion as of end of March 2022, and flows have remained positive in the first quarter of this year, despite negative performance across many themes in the current environment, which shows us that investors are still quite positive for the future of different themes. And one of them is climate change and sustainability. So, for example, the COP26 was merely one example of the trend of lowering carbon emissions. And while our potential to become a carbon neutral society may be uncertain, the desire for tangible solutions has never been higher, like, for example, batteries. However, another area where we are even more excited is large-scale storage that can be useful on the overall electric grid. So this is typically termed grid-scale storage. And this area is exciting because if the world is ever going to be able to deploy solar and wind power at scale, there has to be a way to normalize the non-constant output. So what I mean by that is when wind and solar is strong and we are able to generate more power, we need to be able to store that. And then we have to be able to release it again when, for example, sunshine is missing, like during the night or in winter. So therefore, it is very difficult to imagine that there will be less demand and investment in energy storage technologies over the coming decades. And besides that, cybersecurity was the second highest asset gatherer in thematic ETFs quarter to date. And while mega trends are a long-term structural shift, they're often catalyzed by certain events. And now, with the war in the Ukraine, this has the exact impact on the energy transition and the world's need for better and more cybersecurity.
Okay, thanks a lot. You didn't mention, but perhaps this is not a theme. You didn't mention so far, or you hardly mentioned cryptocurrencies, and this is one of my favorite subjects. And I wanted to ask you, like 2 years ago, the market for cryptocurrencies, for ETPs based on cryptocurrencies, that market was pretty much non-existent. If I'm not mistaken, it was 2 years ago, about 2 years ago, when we've had the first product launched for Bitcoin. Now, fast forward 2 years, and now we have a multitude of issuers issuing products. You've got a multitude of cryptocurrencies, not only Bitcoin or Ether, it's Solana, Polkadot, and so on. And I think we've got about 30 different products listed in Germany alone, including, and I think you've mentioned it, the baskets of cryptocurrencies. And I wanted to ask you 2 questions on that. The first one: do you believe that this cryptocurrency ETPs is that the new area of super growth? Are we to expect because the pace of growth in this area has been phenomenal over the last 2 years, but the market started from literally zero. So you think it's going to grow at that pace for a long time? Is that a new super growth area, or is it just a short-term thing? So that's the first question. And the second one I wanted to ask you, do you believe that those products will change investors' attitude towards cryptocurrencies?
Yes, so WisdomTree launched our first crypto ETP in 2019, so that was Bitcoin. But especially in the last year, we saw that there is much more to the crypto space than just Bitcoin. WisdomTree itself, we have launched 3 crypto baskets. We have added additional single trackers, and there's much more in the pipeline. So yes, it is a very growing, fast-paced environment. But especially because this is such a fast-moving space, I think it's important to know which cryptocurrencies do have a real investment case behind them and which are not. So for example, for our crypto baskets, we have an internal index committee that will review the baskets on a quarterly basis. And if there are coins who do not present a clear use case any longer or are under regulatory investigation, they will be removed. And I think here we have an advantage coming from our commodity side, because we usually get requests about niche products like cobalt or lithium or rare earths. And while it might sound like a good idea, there are always other factors that we need to consider before launching a product, such as the liquidity in the underlying market. So this really has helped us in the crypto space. And regarding your second question, so most institutional investors we have seen are coming to the space using ETPs, because compared to having your own wallet, ETPs apply seamlessly into your existing trading platforms, and they offer transparency and liquidity. And when it comes to crypto exchanges, they are a bit different to traditional exchanges because there's no cross-exchange liquidity, meaning that, for example, Bitcoin may trade at another price in Binance versus Coinbase. So also at WisdomTree, our physically the products are physically backed, and the keys are held in cold storage, which means offline, so you don't need to worry about your wallet being hacked. So I think while many investors do not want to deal with the complexity of holding crypto directly in their portfolio, there is certainly an interest in an institutional offering, and this is exactly what WisdomTree provides with our crypto ETPs. So while crypto remains an unregulated space, institutional investors can access it through a regulated wrapper.
And this is a relatively new product, these crypto ETPs. But from your experience so far, what's the typical when we think about the retail client? What would a typical retail client for that product look like? Because I came across some various different attitudes towards it from people thinking ETN for cryptocurrency, this is something unbelievably complicated, too innovative, just too much for me, to an attitude where I was presenting this product to a group of students, and one of them just told me that this is Bitcoin is being purchased through a product issued by a massive asset manager listed on the gigantic stock exchange in Germany, purchased through a broker, one of the biggest banks in Poland. This is like it's like a way old people would buy a cryptocurrency. There's nothing exciting about it. But then on the other hand, you've got completely different attitudes. People thinking, what is it? So where do you think what a typical investor today looks like? Typical retail client who's buying a crypto ETN TP.
Yes, so I think from what we see, usually people have probably around 1 to 2% of investments into crypto in their portfolios, which is not too much, but you still have crypto in there in case it rises. And I think it's more the curiosity of people who want to know what is going to happen, and obviously those who like to speculate a lot. But there are also people who, we talk to a lot of clients. They really know what's going on in the space, and it's not just speculation. It's they understand the new technology and what it can do in the future. So it's really investing in something new that has the potential to change the markets in the long term. I think at the moment there's probably a bit uncertainty about which of the different coins are better to invest in. But in general, yeah, we see a lot of investors are just very curious or really believe in this new technology.
Okay, so from what you're saying, it's an adventurous, perhaps an adventurous product, but most of the time bought with caution by clients. So that's probably the way it should be. I could be talking and asking you questions for probably another hour. It's very interesting, but we came to the end of today's panel, today's conversation. Once again, Anika, thanks a lot for your brilliant market outlook, and Anita also thanks a lot for sharing your thoughts and your knowledge on the ETF, ETP market. It's been an absolute pleasure, and hope we'll have a chance to have this sort of conversation, this sort of meeting again at some point in the future. Thanks a lot.
Thanks so much, Kamil.
Kamil is staying with us, ladies and gentlemen, as soon we are having yet another part of this conference, investments without advisors. How ETFs empower and promote investors' independence. So again, Kamil Szymański from mBank Brokerage. Good morning. Over to you, Kamil. Good morning, ladies and gentlemen. This is going to be yet another part of this Warsaw Passive Investment Conference. I'm going to dwell on how investors respond to it all from a practical point of view. Are they buying it or not? Are they listening to us or not at all? Are we inside a certain elegant bubble? It is very conference, or maybe we are perfectly divorced and detached from the investor's standpoint, or perhaps we are talking things which are revolutionary for how clients invest in Poland, something that will be decisive over the next couple of years. And now, we can split clients to various groups. The basic ones are investors who are more or less independent. There are very many investors who are not that independent, who are not that willing to take their own decisions. They need advisory. They badly want consulting. They need to be, in one way or another, encouraged to invest. And there's a great number of them. And there's a great number of investors who use advisory, professional advisory. So that is group number one. Secondly, we also have independent investors. They are keen on reading pieces by analysts. But at the same time, they are those who want to decide on their own, as they want to be the ones actually managing their investments themselves. So I'm going to focus on how tools for investors can be revolutionizing the ways how investments are purchased. If you read the papers, if you read the accounts, especially the ones that have been published recently, you may have come across pieces that say, yes, we've got decreases, many sell, many close their accounts. I'm speaking of investors, and this is the trend that we see in Poland and in the whole Europe. But the background in Poland is as we see.
Euro i udziały na rynku na koniec 2000.
If you look at the number of assets or the value of assets managed, Poland is in 11th place. And the share of Poland in these assets is 0.2%, which is almost nothing. We realize that Poland is not the biggest or the richest country in Europe by far, but we have been used to these kinds of statistics, which come from the end of 2020, where Polish GDP is in 6th place in Europe. Obviously, much smaller than Germany or Spain, but not 150 times smaller than, say, Britain or Germany, not 50 times the French GDP. So we are more used to these kinds of statistics. This has come from Eurostat. If you look at the Eurostat statistics and look at how much Poles spend on foreign holidays, or how much Poles buy new cars, or how much share Poland has in car purchases, then this picture would be similar to this one here. We are in the 4th or 5th or 7th place with a very solid share, but usually just behind France or Germany or Spain. If Poland stopped buying cars yesterday, or the European market would feel the pain considerably. If Poles stopped buying into mutual funds, no one would notice. What is the reason for this situation? Well, perhaps this is the subject for another discussion, but without being too controversial, I would venture to say that we have the picture of a market that requires some sort of a boost, some sort of an impulse, some sort of qualitative change. This is not the kind of a market which should rest on its laurels. If you look at the upcoming changes, there are not very many of them. There are certain regulatory changes, things coming from KNF, things coming from Brussels, some, legislative tweaking in response to some big scandal, but no big dramatic changes. However, if you look at it from the side, if you look at slightly different areas than the ones that we traditionally look at, you will notice that there are some very profound and fast changes taking place in the market, in the general attitude of Poles to investing. If you look at this graph, which is based on a research of the Polish Individual Investors Association, the only such association in Poland, you will see the most popular instruments in the Polish investors' portfolios. This Individual Investors Association groups the active individual investors. And so this is a very reliable research. You can see that the most popular financial instruments are shares listed at the Warsaw Stock Exchange. Just below are the new Connect shares, also listed at the Warsaw Stock Exchange. But already in the 3rd place, the biggest growing product is ETF funds. This is a financial instrument that just a few years ago no one even talked about. But if you look at this growth, the ETF funds may likely jump over the new Connect instrument and become the 2nd most popular instrument in Poland among the financial investment. I happen to work in a big brokerage house, and so I work very closely with customers, with investors. And so these findings of the survey certainly trail what I notice in among the mBank customers. This shows you the mBank customers who have had at least one ETF transaction. In the year 2019, we had almost 2,000 such customers who had at least one ETF transaction. And I remember 2 years ago, at the first edition of Warsaw Passive Investment Conference, I bragged about this number. I said, look, our huge jump. We just had a couple of hundred a few years ago, and now we have 2,000 such customers. And this looked like a really big, impressive figure. However, in 2020, we already had 12,000 such investors. Last year, 24,000 such investors. And if we estimate customers who will have at least one ETF transaction via our brokerage house, this year we conservatively estimate that it will be about 30,000 such customers this year. The mBank brokerage house is one of the biggest brokers in Poland, but obviously not the only one. So if we expect this sort of rise in our brokerage house, then we can certainly assume that in the whole of the market, there will likely be 100, 200,000. We're talking about an instrument which just a few years ago was non-existent. So that is very impressive. If you look at the growth of this instrument and its popularity, it's hard to find arguments against the conviction that in a very short period of time, 2-3 years, persons using ETF products in Poland will reach 1 million. Where do these figures come from, and what is the background for this development? Well, we obviously have to look closely at the ETFs and their characteristics themselves. But we also have to look at the understanding of the reasons why this is happening, because in a few years, some people will be surprised when they will find out that ETFs are in the portfolio of every second investor, or that there are 1 million customers who buy ETFs, and they would like to understand what has happened. In the Polish case, it is specifically interesting because if you compare Poland with other European countries, and if you look at this graph, you will notice that 60% of the share in the investment markets are the retail customers. So when compared to Europe, we are a very small market, but we are at the same time a market which depends very much on individual investors. What is the basis for this change? What causes the situation with that the ETF market is really bound to develop rapidly? If you look at the ETF market, you will notice an interesting feature. Those who are listening to me now know these figures probably. I keep reading all kinds of newsletters, and I obtain these ETFs from both issuers and companies, and sometimes it's too little time for me to read the headlines of these newsletters, because they keep telling about new inflow, new record of buying ETFs, thematic ETFs, American ETFs, bonds ETFs, whatever. So you can see some new company bringing down the charges and new innovative products entering the market. So this part of history is well known to us, and we've heard so many times about the passive revolution. We know this story. But just as the passive revolution has been talked over and over, we don't talk enough about the fact that the passive revolution is a revolution of independence. The figures that I showed you a few slides ago, the number of customers of our brokerage house which purchases ETFs, and the prediction that very likely there will be a figure of 1 million in Poland, these are investors who take these decisions via their own brokerage account. They buy, then they sell. It's not the investors who came into a financial company and heard, well, perhaps you would like to buy this product. No, they took this decision themselves. So the passive revolution has given a boost to this independence and created this independence revolution. And you can see it clearly in all kinds of segments of the market. What is this revolution of independence? What is the foundation for this trend where more and more investors want to purchase investment products on their own? And why do they go towards the ETFs? So let me present different constituent parts of this trend and the impact which they have on investors and how they take investment decisions. Most of the aspects that I'll talk about are well known, but I don't think it is appreciated enough how these different factors contribute. The first one, the democratization of investing. I'm sure this is the slogan that we've heard over and over again. Investments are open for everyone now. But do we appreciate the manner in which this democratization is happening and the speed in which it's happening? On the left, you have this typical caricature of the robber baron, the old-style banker. Several years ago, I worked in the London City, and let me tell you, I did see similar types when I went to get my lunch at noon and went to these, snobbish, walked by these snobbish places. I would see figures like that in these snobbish eateries. I was always wondering what sort of work do they do to afford this kind of lifestyle. But I believed, well, if you work harder, you probably get to that position one day. And you can have these champagne lunches, scoffing shrimps. But I doubt whether this is the case still today. However, this slide illustrates that even in America and in Western Europe, an independent investor 10, 20 years ago was a rarity. An individual investor who wanted to have access to the markets, to funds, to options across the world would have to face a wall. ETFs were not popular, investment platforms were not so widespread. It was very hard for investors to participate without intermediaries, without brokers, advisors, or banks being intermediaries in these transactions. Over the past few years, this has all shifted, and everyone trades on the platforms. And via the platforms, the applications, via our laptops, we have an access to markets across the world. Now, a person who lives in a small town in a faraway mountain location in Poland, if the person wants to have access to the Chinese or e-commerce market or buy gold, they can do it with a few clicks or a few taps on the smartphone. A few years ago, they didn't even have that option. So the difference between what was available and is available now is like day and night. The democratization of investing is not just about the access to the tools. It is also based on the access to information. Several years ago, it was very different. What is the second pillar of this revolution of independence? Well, again, something that we've heard over and over again. The conservative attitude of the professionals. And you can see the illustration which shows you the number of active managers which benchmarked S&P 500, the most popular world index, managing the largest American companies. And the percentage of funds outperformed the S&P 500 last year. So a simple exposure to a simple index would beat the strategies managed by professionals. This is the well-known story, and a page that I can recommend, S&P Dow Jones indices, where you can see indices from across the world, including Poland, Asia, all kinds of funds, bonds, real estate, what have you. And there you will have the statistics. But obviously, there are loads of this type of information in the internet, and I could create 20 slides based on these tables, whether it's a bonds fund, whether it's a 5-year period, a 6-year period, or Europe or Asia. The picture is the same. Indexes win with the managed strategies. But it seems to me that the market participants do not notice the impact on their customer. Because let's say if we had some professionals here and there was a panel, a discussion about that, they would say, well, okay, it looks like that, but if you take into account the other aspects, then it really looks much different, and there would be a discussion. But the investors see this, and the internet is full of these types of statistics. In the internet forums, they keep talking about the change of decision making. This is a change which represents a development where someone decides that they will invest in the Polish or American companies and decides that he will use the passive fund because the performance is better. So the change in the customers is much, much larger, goes much further than that, because customers who see these statistics get convinced that they don't need specialists to invest. They realize that they have the power, they have the tools at their disposal, thanks to which they do not need specialists. And they have the second pillar of independence. They have the access to an incredible number of investment products. And they can take the decisions on their own, and they don't need any specialists. And the third factor, one of the basic reasons why ETFs and the passive strategies have become so popular, is the charges, the low price. They are sometimes by a factor of a few dozen cheaper than other instruments. There's two aspects of these charges. Eric Balkunas was a keynote speaker at our conference a couple of years ago, and he recently published a book, just 2 weeks ago, in fact. He published a book about John Bogle and Vanguard, and the story of the development of passive investing. The title of the book is How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. The trillions is not a hyperbole. It is not a metaphor. Even if you look at the Polish market and the several billion euros in the Polish investors' portfolios, if you look at the charges for fund management historically between 2, 3, 4%, investors in Poland pay billions every year into these charges. And it is very easily to imagine that if these billions over the past few years were not vanishing, perhaps our share in the investment funds in Europe would be greater. On the other side of the slide, let me recommend to you the Morningstar report, the biggest independent company in the world in analyzing financial markets, and the Global Investing Experience study evaluates every year all the markets, all the major world markets in investment funds from the point of view of the performance and the transparency and the charges. The number one country where investors in Europe pay the lowest fees for sometimes the same investment funds is the Netherlands. The Netherlands is number one and the cheapest rates, and they have the biggest rate of adoption of ETF, which is not an accident. The country where you have the largest adoption rate of ETFs is also at the top in terms of the charges which the investors pay.
Są w stanie używać.
Those people feel empowered. They can use these products. They don't need a specialist, and they are not afraid of any fees. And they feel further encouraged as these ETF solutions are very transparent. They are very friendly. They are very investor friendly, especially in this terms in the terms of fees. Secondly, another pillar of being independent as an investor is simplicity. It is on various occasions that I come across someone saying ETFs are cheap. They are friendly. There is a plethora of them, but what should I do just to be able to navigate in this very complicated landscape? We've got Wisdom Tree, we've got StateStream. There are many different players. They all issue a dozen of ETFs per annum. And what should I do? What should customers do just to be able to navigate and to manage it, to manage all this landscape? Simplicity of choice is by way not a problem, and simplicity is yet another, if not decisive, pillar of independence. How to choose an ETF from amongst thousands of them? Let me illustrate it based on how we choose a car. There are issuers, or better to say manufacturers of cars. There are many of them in Europe, more than ETFs issuers, but still there are many of ETF issuers and there are many of car manufacturers. There's usually a dozen of such actors. So look at the automotive industry in the world. There are hundreds of cars that we can choose from. But if one wants to buy a car, they are not desperate in rushing to brochures all over. Normally, they have 2 or 3 filters in use. They narrow down the choice just to a few models. If they are interested in SUVs, middle class or premium European SUV, there are 2 or 3 filters in place. From hundreds, we land at a few, Volvo, Audi, etc. By the same token, if one wants a family car, German manufacturing, 2 filters in place, and we arrive at Volkswagen Golf or Ford Focus or something that may come to it, some Opel. So as said, there are 2 or 3 filters that significantly narrow down our choice to just a few options, and then we dive deep to see what kind of engine may be one of our preference. And the same mechanism applies to ETFs landscape. Let's consider. We've got, for the moment, around 8,000 or 9,000 ETFs traded globally. In Europe, we've got around 3,000 of them. Brokerage houses offer us 300, 400 or 600 ETFs, and this is everything that is at our disposal. But let's employ this optic. How simple is it to find the ones that cater to our needs? Previously, we saw that it is indeed the most popular tool among investors are equities on the stock exchange. Second come ETFs. Naturally, the first resort for many of customers would be to merge those 2 areas. That is, ETFs that would be traded on the WSE. So let's imagine an investor figure. We've got 9,000 ETFs, 3,000 in Europe, and hundreds of ETFs in the offer of every brokerage house. It's enough to have two filters in place. I want to be one ETF that is traded on the WTC. I want to have an ETF that is listed in one of the most popular indices in Warsaw. From 9,000, we have free, beta, etc. So the choice is now very simple. Someone can say, okay, foreign markets are remarkable, and the number of ETFs traded in Warsaw is something very moderate at best. If one wants to buy an ETF on S&P 500, the most popular benchmark globally, that's one filter. Secondly, they prefer the biggest cap. The ETFs of biggest cap, Invesco, iShares, and others will come to it. So from 9,000, we have four. If one wants to have a thematically oriented ETF, be it in the area of cybersecurity, because we hear news about cyber attacks, and this topic has been of substantial importance for many years now. It's not soon to vanish from the agenda of the topics. There are companies that deal with cybersecurity, and somebody wants to buy a cybersecurity ETF. There are two ETFs in the most office of the most brokerage houses in Poland. So you've got this. So we've got two filters that we've accommodated. Yet another example, if you please. Somebody wants to have an ETF on the American bonds, and we've got a total of around 6 or 7 ETFs grouped nicely. American ETFs with a select validity date, and somebody determines they want to have a product based on gold. So just one filter in place. Second filter, as they want to have ETFs issued by the most important players globally, and we've got 3 such products. And Bitcoin ETF. As regards products for Bitcoin in Poland, they are still unavailable in Poland, and this is predominantly a very fresh market. But an etc., that is the German exchange, the market has developed rapidly from scratch. And currently, we've got a total of around 30 products on cryptocurrencies, a dozen of issuers. We've got baskets ready for them, etc., etc. Somebody wants to navigate here. They want to have Bitcoin, firstly. Secondly, they want to have one of the most important issuers. And so we've got around 2 products that would very much ascribe to this profile. So there are very few of such products, if such filters have been applied. I can be providing you with newer and newer examples in this respect. So we've got hundreds of ETF products globally, but this decision tree is pretty simple. So you've got very basic filters that you can employ, and so you decrease and narrow down the scope of choice. Should we have already decided on these very few products, as was the case for cars, now we need to compare. Then we need to have a certain benchmark. Do we want this gear? Do we want this engine or that engine? Do we want to have a shaded rear screen so that our children are sunshine protected? So after narrowing down, we still need a few parameters that need to be taken into consideration, and here I can give you an excerpt of what we normally exercise at mBank. So, for example, we don't want ETF for S&P 500 here. Our preference is for euro currency. So what do we need to compare? The size of a given fund, and this information is widely available over the internet, for example, on our website. Allocation, physical or online. Management fees, 0 to 0.501%. This is the kind of range that we are at. Some also exert fees of 0.7%. and questions regarding what is done eventually to this fee. Is it reinvested or is it how is it dealt with? So these are the most basic bits of information that we actually need if we want our purchase to be exercised. Still, you can have a look at errors and other stuff. Sure. Nevertheless, in a majority of cases, for the most ETFs, these are highly standardized products. If you want to juxtapose one against the other, there won't be any dramatic changes. It is not like one replicates the system very nicely, others don't perform that nicely. This is not the case. So, imagine we've got the figure of an investor. They are empowered. They feel they can take their well-informed decisions. They're not afraid, they're not concerned about the fees. They can narrow down the scope of choice in search of products, and that would be very much in line with their interests. And they've got all the parameters in place for the choice to be actually made. And there remains one single question, i.e., how to exert control over it all. Control over your financial portfolio is normally dealt with over the financial scheme of our brokerage house, from our laptop, from our smartphone, and we can access it at any single moment. We can review what we currently have in our portfolio. What's the valuation? This is something that we can enter at any given moment during the session. So we've got basically a tool that helps us manage it all. Let's look holistically, shall we? A few years back in Poland, ETFs were then inexistent. All these options were inexistent neither. They've just popped up overnight. And soon we arrived at the current situation, i.e., we've got an investor anywhere in Poland with a smartphone access allowed for all the global financial markets. This is allowed by standardized products issued by substantial asset managers listed on significant exchanges, all intermediated by large brokerage houses. These are transparent products and these are cheap products. By and large, if we put all of this together, we can easily explain why ETFs are gaining so much popularity abroad. We can also explain why ETFs are gaining popularity here in Poland. And so we can imagine these products are bound to be available to as many as 1 or 2 million customers. I've been talking at length about many issues. Still, I haven't mentioned the barriers that still exist, be it of regulatory character, and the ones which prohibited the American ETFs for individual clients. There's still fragmenting going on the market, and there's one issuer for one ETF in the United States, and in Europe, one ETF can be listed in Frankfurt, can be also listed in London. And this very same ETF may also be listed in various currencies. Does it pay a dividend? Doesn't it pay dividend? And these are all the issues that one has to take account of, and therefore this market requires more attention to be paid to. And there's one more question, that is access to education, information, dissemination. The European markets, I'd like to conclude, are very much lagging behind towards investors' expectations. There are, of course, independent investors, and they are eager to follow expertise and expert comments, and which is still a scarcity on the market. Is this information barrier too high? Is this threshold too high to enter? Think. We talk about independent investors. There are investors for whom those barriers are too high, and they can enjoy their very own offer, tailor-made advisory offer. Now, we are referring to investors who only need certain tools to have at hand. Judging upon the pace of how ETFs are being adopted, these barriers are not detrimental or for ETFs market growth. Just notwithstanding, there is still a lot of work to be done with regard to dissemination, and this kind of educational or dissemination offer will only get improved and to be available for masses. Now, wrapping up, let me return to this bit of data. Looking ahead, what the market will be for ETFs in Poland. I've been following the global markets for quite some time now. And now I know historical record highs soon become something very much of average. Look at 2019. This is some plateau. If we employ a current perspective, it was something of a breakthrough 2 or 3 years ago, and now we just regard it as a plateau. So something very insignificant, very negligible. And I'm certain to say that the Polish ETFs market and ETF markets globally something that is bound to be successful, and we are at the actual start of this journey. And I entertain hope, should I be able to take part in this Warsaw Passive Investment Conference anywhere in the future. Hopefully, I'll show you something very similar, where we can see the same situation replicated. Contemporary highs are going to be plateaus of the future, which will subscribe to ever-growing popularity of ETFs and passive investment instrument opportunities. Let me wrap up there. Many thanks for your attention, and please get to know more about passive investment and ETFs in general. Thank you. This was Kamil Szymański, Deputy Director of the Regulated Markets mBank Brokerage House. Thank you very much indeed. Now we pause for a bit, and we are going to reconvene.
Szanowni Państwo,
We resume the second day of our conference, Warsaw Passive Investment Conference. We will now talk about ETF trends. Specifically, we will wonder where the money flows and what products are the future of this particular market. Ewa Miklaszowa from Invesco will answer the questions asked by Michał Kobza from the Warsaw Stock Exchange.
Good afternoon and welcome to Warsaw Passive Investment Conference 2022, presentation and panel discussion about ETF trends, money allocation and products of the future. This is yet another panel where a representative from a global passive fund management company will share with us some insights on the development of this type of products and provide hopefully some guidance on where the future of passive investment is heading. I'm joined today by Ewa Miklaszowa, Head of ETF Business Austria and CEE at Invesco. Hello, Ewa.
Good afternoon.
Ewa, great to have you on the call today with us. So for our viewers, the scenario for our meeting today is as follows. Ewa will start with a short presentation, and then we will have a short Q&A session with Ewa about the implication of these global trends for asset management industry. I will also ask for more details about money allocation. How should investors react to these days uncertain future developments, and what the conclusions for CE investors in particular will be. So Ewa, the floor is yours, and talk to you after the presentation.
Okay, perfect. Many thanks, Michał, for a very kind introduction. Good afternoon again to you all. I'm very happy that I can represent Invesco at this conference today. So maybe again, my name is Ewa Miklaszowa, and I am Head of ETF Business for Austrian and CE region. I am part of the broad ETF team Invesco, and I am based in Vienna, actually, where I've been working for almost 10 years in financial industry. So in the next 20 minutes, I will share with you, firstly, some recent developments in ETF market. Then secondly, we will answer the question, what are the longer term trends in ETF market and in general? And then we will have a closer look at ESG and thematic themes. And at the end of the presentation, I would like to explain to you some differences between the various replication methods of ETFs. So let's move to another slide. All right, so let's start with Invesco, like Invesco as a company. So Invesco is one of the leading independent asset management house in the world, and is managing around $1.6 trillion in total. But Invesco is not managing just ETFs. Invesco is managing as well active mutual funds, alternatives, solutions for clients, so creating solutions depending on the client demand. Of course, ETFs, as we are here today, and other products. So in ETF space is Invesco the fourth largest player globally and the sixth largest in European region. What is interesting that since beginning of the year 2022, Invesco was in the third place of inflows in Europe in ETFs, and Invesco ETF business have increased by 7.7% despite the negative market movements we saw in the first quarter. So the next slide. Cool. So let's start with some short-term trends. What is going on in the ETF markets? What is the ETF market overview? And what are the developments in the recent years in this space? So as you can see in this chart, ETFs has been growing tremendously. And what we are looking at here are $10 trillion invested globally. What we can clearly see here, that global ETF market had impressive growth in the last 10 years. And looking at from below 2 trillion, for example, like decade ago, we moved to 10 trillion now. So which means when we recalculate this, that ETF market doubled every 4 to 5 years, which is an excellent development. From the regional perspective, looking at the dark blue color in the chart, this is showing us the US ETF market. When you look at the light blue color, this is for European ETF market, and the violet color is for Asian ETF market, and the purple at the end is Canadian ETF market. And as you can see that the US region is the biggest one in this ETF market, which is followed then by European market and then by Asian market. And as well as European, so as well Asian market have been growing quite rapidly. So in the next couple of slides, we will show you some short-term developments in Emea ETF market, but as well some longer-term trends and themes. So first, let's have a look at some short-term tactical developments in Emea ETF region, which happened since beginning of the year and which we have observed. So for some of you, maybe these developments pretty obvious, but for some, they have been under the surface, so not quite of obvious as you might see. And what you can see in this slide is Emea ETF industry flows. So starting on the left-hand side, you can see yearly inflows in Emea ETF industry, and we can see $50 billion inflows only in the first quarter of this year, which is consistent with what the year, for example, 2015 or 2016 was. So which is great development, and this puts this ETF Emea market roughly on the trend to over $200 billion for this year, as it was achieved as well in year 2021, which was quite a record year in this regards. So again, very strong start of the year. Now let's look on the right-hand side, what we can see here. So here we can see the split of ETF Emea industry flows to the asset classes. So what we can see with violet line are equity ETF flows. What we can see with dark blue line are bonds ETF flows, and with the light blue lines, you can see commodity ETF flows. And when you look at this chart, it is quite clear and visible that in the first part of the year, mostly in January, the biggest flows we observed has been in equity ETFs. But what you can see as well, that it was kind of spot on in the Ukraine invasion when the equity ETFs of inflows stopped and the trends changed towards outflows in this equity ETF space. It was exactly, I guess, 10 days after the Ukraine invasion, more concretely from 25th of February to 10th of March, we saw around $5.7 billion outflows in equity ETFs, but this was kind of offset with 2.6 billion of inflows in commodity ETFs, and it was mostly gold ETCs. And this was a lot when you compare this $2.6 billion with the size of the usual ETC, gold ETC products. So very strong development in this side of commodities, mostly ETC gold products. So let's look even more in details on what happened in the first quarter of this year. And what you are seeing here on this slide is the split between different categories in the market. And on this slide and in these two tables, you can see on the left-hand side, the top 10 category inflows. And on the right-hand side, on the other hand, top 10 category outflows for the first quarter. And what you can see, of course, in the table on the left-hand side, that the top two biggest inflows we observed in global and US equity. But this is no surprise, because usually when equity inflows dominate, which they dominated in the first part of the year, then the global and US equity usually are leading in this space. But what is interesting to mention is smart beta category, because this is not so usual that is this the third largest inflow in the equity space. And what we could observe here, at the beginning of the year, there were strong inflows in like kind of factor-driven equities, like value factor. And then it slowed down. And after the Ukraine invasion crisis, then the strategies like low volatility or quality started to getting attention in this space. What is as well quite interesting to mention that emerging market equity flows has been surprisingly resilient despite the rise of Russian exposure. You can see as well in the table on the left-hand side. And to mention that European equities, they had quite a strong start of the year, but then after the Ukraine invasion, it shifted to the outflows territory. And as you can see now on the left-hand side of the table, by outflows, then European Monetary Union is the kind of biggest outflow category, obviously because of this kind of conflict between Russia and Ukraine. I didn't mention Japan. As you can see, there's the first position of outflows. But Japan, there is no clear significant idea behind, because as I learned, this is just one big institutional investor moving tactically their investment. So no value in this information. So this was the first quarter of 2022 ETF industry flows. Now let's have in April. So what happened in April and how this changed in the beginning of April till last week of April. And what we observed is that the inflows in global is continued positive. We saw a slowdown in US equities. So it has been really cautious about investing in US equities. And then as well, we observed increase of inflows in thematics, and this was mostly clean energy products. And then on the fixed income side, we saw stronger inflows in shorter term US treasuries. So we've been observing like a shift from longer term bonds to shorter term bonds, obviously, because of the interest rate risk and so on. And on the outflow side, we continue to see outflows in European equities, European Monetary Union's equities because of the conflict, as well in European corporate bonds, in European sectors, and so on, and as well at the end in European govies, with a slight inflows in European government bonds as well, the shorter term. But overall category of European government bonds was in outflows. So that was the short-term tactical flows in Emea ETF market. Let's switch and let's look at the market from a little bit like mid-term, longer-term perspective. And because not everything is about tactical allocation or allocation between this month and the next month, a lot of our investors are investing in the long term for the retirement, for the kids, and so on. There are many of reasons why to invest, and often the investment is for the horizon of 5, 10, 15, 20 years or even longer. So what are the two big themes which we are observing in the market, which are changing as well the whole market environment? So we identified, first of all, the one big trend, ESG, and the second big trend, thematics. So I will now really give you a deep dive in these two trends during the next couple of slides in this presentation. So let's start with ESG. I guess I don't have to explain here what ESG means, but for those of you maybe who didn't come across with ESG yet, so ESG means that portfolio managers are implementing environmental, social, and governance criteria in the investment process. And as we can see in this slide and on the chart on the left-hand side, the demand for the ESG and number of products in the market are increasing very rapidly. And looking at the data from the 2021 of the Emea ETF industry flows, of these total flows, there has been half of the flows in ESG ETFs. And when you look now at the number of the ESG products, so this number of ESG products, as you can see with the light blue line, in the passive space had more than doubled since 2020. And when you look in the right-hand chart here, so there are a couple of different ESG strategies. So it is not so simple as it maybe seems to be. They've been developed a lot of new passive space strategy, like, for example, social responsible investing, like best-in-class investing, which is kind of strict. Then best-in-class investing, which is moderate. Then exclusions, so which means you just exclude the worst companies. Then tilting methods, then kind of climate-specific methods, or like Paris-aligned strategies. Some kind of very like thematic strategies like clean energy, solar, and so on. So there are many strategies in the market. What is quite different and difficult for the clients is how to navigate between them, because now it's a lot of them on the market. It is already quite difficult for institutional investors to navigate, not mentioning a lot of clients who are not doing full-time job by managing the funds to navigate, so which each ESG strategy to choose from. So, and I would like to simplify it for you a little bit. So the main difference between the strategies is, so how strong are the ESG selection criteria from the light green, which means few ESG criteria, to the dark green, so like very, very ESG products. And this is as well dependent on, and this is now caused then differences in tracking error. And I will pause here a little bit because it's getting maybe too technical. So what means tracking error, and why nobody wants to have who is investing in passive tracking error? So tracking error is increasing with the deviation to the standard index. So I will give you a very simple example. So imagine you have an index with 2,000 stocks, and then you decide, okay, I will run another index, which is ESG index, and I will exclude from this index 1,500 stock. At the end, I will end up with 500 stock portfolio versus this 2,000 in original one. This difference is causing, of course, as well difference in performance. And this difference in performance could be positive or negative. And this difference of this performance between my new ESG index with 500 stock and my old one, original with 2,000 stocks, is kind of higher and is causing the higher tracking error. And now, so what you can see here on the chart on the right-hand side. So on the x-axis, you see the tracking error versus non-ESG benchmark, so versus this classic MSCI World and so on indices. On the y-axis, you can see ESG score improvement. So what is obvious, when you are investing in the classical passive funds like MSCI World or MSCI US or MSCI Europe, you have 0% ESG score improvement and 0% tracking error increase. Fine, but you are not doing anything good from ESG perspective, and as well you are not increasing your risk in your portfolio. But you want to include some ESG criteria, automatically your ESG score improve, but as well your tracking error increase. And that's the ratio. And as you can see, so how you can navigate between these ESG products. So as you can see that one step towards a little bit higher ESG score with a very slight increase in tracking error are kind of the exclusion indices. So when you do just the basic exclusions, you're just excluding kind of coal or tobacco or these basic non-ESG stocks. Then you can go one step further and to weight a little bit differently the stocks in your portfolio. So you will give higher weight to the companies which are doing better from ESG perspective and lower weight to them which are doing worse, and add some simple exclusion to this as well. Then you can go one step further as well. Then you just exclude the 50 bottom worst companies and you keep just the best 50. And then you can go even one step further in ESG, that you just keep the best 25 companies and exclude everything which is not good enough for you. And at the end, you are ending with very strict social responsible indexes with additionally low carbon targets and so on, which are, again, connected with very high ESG score improvement, but as well very high tracking error. So why I'm talking about this so long? For many investors, this is very important, because some investors, because of this reason of the higher tracking error and higher risk in comparison to standard benchmark, these investors are selecting rather lighter green ETFs for their portfolios. Just they slightly improve ESG score, but not deviate too much from standard benchmarks, and they are fine with it. It's completely okay. But then you have another investors who are creating really like dark green ESG portfolios, real focus on ESG improvement score, on carbon emission, very strict exclusion criteria, and so on. They are getting very high ESG score, but as well very high tracking error. And this is what they want. They aim to differentiate from the standard benchmark. They want to differentiate, and then they are selecting the new ESG indices as a new benchmark. So the question is now, maybe you are asking, what is better, where I can earn more, or what should I choose? So this is difficult to answer, depending. Every deviation from the standard benchmark is connected to some tracking error risk, which can mean outperformance or underperformance, depending on if the ESG is in favor or not. Regarding the statistic and the numbers, what we could observe till now, so in Emea ETF industry, there was roughly 50-50 split among the investors looking to darker green or to lighter green ESG solutions. So it is more like, what are your guidelines when you are institutional investor, or maybe what are your personal preferences regarding ESG topic. So let's move on now to something maybe more interesting or more trendy, which are like the next huge big category of longer term trends, which are thematics. So looking at the chart and looking at the slide, we can obviously again see that as well thematic investing has shown like very significant growth in the last couple of years. What you are clearly seeing is in this chart that we saw positive inflows, we observed growing asset under management, and we as well observed growing number of ETFs in this thematic space. So looking at the dark blue bar means asset under management. And when you can see that this asset under management has more than doubled from 2019 to 2020, and is growing further as well. It was growing further in 2021. And now again in the first quarter, getting attention mostly in the clean energy space. When you look at the number of ETFs, this number of ETFs as well doubled since 2018, which is shown on the chart with the purple line. So this demand for thematics is strong and is continuing further. But before we deep dive a little bit in detail about thematics, let's define, okay, fine, thematics, nice, it is growing, but what is it, this thematic investing? I heard about artificial intelligence technology, but these are technology as well sector. So what makes thematics so specific and so different? So thematic investing usually offers exposure to companies that may have the potential to deliver strong secular growth based on some long-term transformative trends. So some trend which is emerging, which is long-term, which will change the way we live, the way we work, and will transform the economy. And these trends usually don't evolve in short-term period, like when you have new technology in like automatic cars, for example. It is not something which will come from today in tomorrow, or which will be realized in 1 year. Usually it's like smaller steps, consistent over the years, and this trend is increasing and is even more important in the future. And the idea is here to to discover the trends now which have the potential to be like the new future in the future. So the primary reason why investors are investing in this thematic space is firstly potential for outperformance. As what you can see here on this chart, this is one example about biotech. That biotech is as well one of these kind of thematic examples. And biotech was, from the longer term perspective, outperforming the classical standard index MSCI world. So what is, of course, very important to mention, there is potential for higher outperformance, for a higher return in thematics, but you need to keep in mind that there is as well high potential for higher volatility, which is very often when you have higher return, then you need to be prepared that your portfolio could have higher volatility. And the third reason why some investors are looking at thematics are low correlation to standard asset classes. So let's have a couple of concrete examples. So let's make this presentation a little bit more interesting, moving on from the technical topics to more like real life topics. So what are the themes which this thematic investing is including? So I categorize them on the in the 4 big themes, which has like a couple of under themes. So I would start with the obvious one, with technology innovation. So what you can find there, it's a lot of things which you are hearing from every corner. Let's mention a couple of big ones like fintech, blockchain, artificial intelligence, and robotic. The next one, I already discussed this in the detail, are the sustainability trends. So these sustainability trends are very connected to ESG, long-term trends. And you can find here like topics like clean energy, like electric vehicles, solar energy, water scarcity, energy transition, and so on and so forth. Then the third biggest part of this are healthcare developments. Here I have this example, what I already mentioned, like biotech. And the last one are demographic changes. We heard a lot about aging population. We heard a lot about millennials and so on. But let's have a look in some details about a couple of, because not every single one is so clear or so obvious. But let's start with the simplest one, which is biotech. So what is biotech? Biotech is simply a combination of 2 subsectors in the market. It's biotechnology and pharmaceutical companies. So what is investor looking for when is looking to invest in biotech? So there are here some benefits of advanced technology in this space, the needs for aging population, so it's interconnected with technology and demographics thematic. Then the antibiotic resistance and evolving virus risks. Unfortunately, we could observe in the recent 2 years. So, and when you invest in biotech firms, so what you are looking at, so what you are looking for, what you want to have when in the company, which is biotech company. So, of course, you would like to see successful drug development, which depends from going through all the phases of development, then have to reach the market, and then you need to get approval as well, and then everything is fine. And this is very difficult to predict. You can remember the kind of run who will create the best vaccine for COVID. There were many of pharmaceutical biotech companies which wanted to create the vaccine, and at the end there was a couple of winners, but in the end it was one big winner of the whole story. So it's difficult really to predict, okay, which company will be the winner. So that's why to have broader diversified exposure is a very beneficial strategy, of course. You are capturing then all the winners, but as well you are capturing all the losers, which are not making it so far. But overall, when you look at the historical development and performance, the payoff was in the past positive. Then let's move on something maybe more difficult, but very much discussed, like blockchain technology. But firstly, let's define what is blockchain. Maybe at the beginning, like specifically to define, it's a ledger or record of all transactions and balances in a given system. And what makes blockchain interesting is the cryptographic nature of it, so that ensures that everybody can see the same version of this ledger, and nobody is able to change the historic ledger in the system. Maybe a little bit too complicated. Let's simplify it. Everybody can see the transaction of everybody, and nobody can change it or hide it. So this is the simplest definition of it. So complete, transparent financial system. So, but what is opportunity here? And be careful, I'm not talking now about some Ethereum or Bitcoin or Dogecoin or whatever. I'm now talking purely about the blockchain technology. So, and what is the opportunity here? To simplify this whole story, I will use the analogy which every of you are very familiar with. And this is analogy of internet. And I can actually call blockchain as internet of asset. So as we know, internet fundamentally transformed the way we interact with information. It's changed how we share, how we access information, and it completely transformed the way we live. So you don't go now to library, or most of us don't go to library to look for some new information. We just Google it, or we are checking the online libraries, or just read some blogs and experience of other people. So it's completely transformed the way how we access the information. The analogy is that blockchain has the potential to do the same for asset as the internet did for information. So it could reduce the cost of creation, cost of custody, transfer and usage of assets. It can transfer the whole way how they live and ensure the new industry in the global scale. And you have two kind of blockchains. You have the private and the public one. The public one is more connected to this kind of all the cryptocurrency topics, but the private one is as well very interesting, because the private one is the implementing of blockchain technology in the company financial system. So the companies which now exist, which are big, are implementing this new technology. But it is not so, easy to invest in this kind of topics. As in thematic investing, often the most difficult actually thing is to find a way how to get exposure to this theme. And one way how you can get exposure to blockchain is just via normal equity index. And that means that you invest in companies which have part of the business model or part of earnings in blockchain development or in blockchain technology and so on. But we are still at the beginning of this new emerging trend. So a lot of companies which now are looking like to have part of the business in blockchain have another bigger businesses. And blockchain is the smaller part which is emerging and developing. This is good and bad. First, the good one is that it's less risky and you have good diversification in case something goes wrong with blockchain, that you have still companies which are doing something else as well. The bad thing in this is so you are not getting the real the exposure as you would get in case in Bitcoin. But you don't have this risk there. So because you are in the companies, and companies are generating revenues, and you can expect how high the revenues will be. So it's like more like stable way how to get exposure in this whole new emerging technology. So it's liquid, it's focused on real earnings potential, and it offers actually the opportunity to gain this diversified exposure on the growth of the ecosystem in the future. So let's maybe mention the last example, which is in the sustainability trends, which is clean energy. I said that we saw new inflows in the first quarter of this year in the clean energy again from the investors. So what is the case for clean energy and why this is such a booming area? The first, I think everyone at this conference will probably accept and believe that we as a world have a climate emergency, and the climate change is a real problem and it's happening. And there's a lot of evidence and good reason that we have to change the way we behave in terms of energy consumption in the first on the first point, but as well how we source the energy and what it will be when not in clean energy that will be the ultimate solution for reducing carbon dioxide emissions. So in case the industry go the way that we really want to reduce carbon emissions, then we need to go away clean energy. So this is, I think, very clear message in this space. And there are companies which are involved in kind of new energy solutions, which are transforming the energy, which are working on the new technology. And these are companies from which then the investors can benefit in the future as the demand for the clean energy will increase even further. Good. So that was thematic investing. And I have the really last point I would like to discuss during this presentation. So moving away from the short-term trends, moving away from long-term trends, from long-term themes, let's stick a little bit with more technical topic, which is how should I or how the ETFs are managed, or how the ETFs replicate the index. And we call it Etf Structure. And I would like to show you very briefly so how different or various ETF structures differentiate, and why some ETFs are replicated with some methods and some ETFs with different, and what this means for you. But one step back before I jump in. So the goal of each ETF is to replicate the index as closely and as cost effectively as possible. That's the main target and main goal of every ETF portfolio manager, to be the perfect index, to be able to replicate perfect index. At the same time as well, ETFs investors receive all income from the securities in the underlying index, and they are participating as well in dividends and interest payments with ETFs. Now, so which various methods are available in the market in this ETF structure for replication? So first one, with the very obvious one and very simple one, is physical replication. So physical replication means that you invest, you would like to replicate, for example, S&P 500, then you take your cash and you buy all 500 companies, and you have perfect replication because you physically buy every single company in the index. This is the physical replication. The second one is sampling. Sampling is that you just select the most important and liquid securities for your portfolio. So you don't buy all of them. You decide, no, I don't want to buy all of them. Maybe they are not liquid. Maybe there is some other issue. I buy just from 500, a little bit less. But they actually, at the end, looks in the first sight very similar to S&P 500. Then the next option you have, you can choose so-called optimized sampling. And this is a little bit more complicated because this selection is made by quantitative models. And the last one is synthetic replication. And synthetic replication, the ETFs holds a diversified basket of liquid securities and then uses derivatives to gain exposure to the index. And it depends on the, and the question is now, which kind of replication methods you should select. And I would answer very, very briefly that it depends on the market and kind of investment, which replication method is more appropriate and more efficient. And usually the manager of ETF and an ETF house are offering kind of replication method which they believe are the best for the index which they are replicating. So with that, many thanks for your attention, and back to you, Michal.
A detailed presentation. I guess the first takeaway I have is that the assets under management will double within the next 4 to 5 years. In this case, we're talking about from 10 trillion US dollars to 20 trillion US dollars, which is impressive. It seems that all the black swans, COVID, war in Ukraine, they can't stop the development of this asset class, which is amazing. The second conclusion I have is that ETFs seem to be fairly straightforward instruments, but under the surface, it's a lot of things are going on in terms of indices, technical, let's say, design of products, and it's investors have a lot to choose from. So my first question would be very simple and I guess pressing questions from the investor's perspective. Where to find returns this year? This year, I mean, we have, again, it's like probably second or third year that we don't have any like clear answers in terms of money allocation, tactical asset allocation. Especially, I mean, this year again is very tough and special in terms, I mean, for our region, high inflation, increasing interest rates. So where to find returns? Can you shed some light on what your clients are doing and what's your take on the upcoming year in this space?
Yeah, I mean, very good question. This is the question which we are asking as well every day at Invesco, and we are as well producing a lot of research papers, and our team who is doing tactical asset allocation in our portfolios and our economies are looking at the situation in the market currently, as the year started not so bad. I mean, the year started very well, and then there was kind of a discussion about that Fed will increase interest rate, and Ukraine invasion happened, and then since then it's a little bit unsecure. We don't know what happened in Ukraine. We don't know what Fed will be really doing, or we guess what the Fed will be doing, but you never know till it happened. So maybe I can share with you a couple of points from the economic perspective, and maybe then to overcome to some views what our specialists in our tactical asset allocation teams are doing here. So maybe to give a little bit background, looking at as well equities, credit, government bond markets all around the world has posted like negative returns in the first quarter 2022. And as I mentioned, it was the combination, the really very rare combination of like historic repricing of tighter monetary policy expectations, then rising inflation, then an inflation expectation before, then the higher geopolitical risks and so on. And looking at that in third quarter in 2021, was like Fed policy expectation was really different from the expectation we have now. Like from pricing one rate hike in end of 2022 was nothing in comparison that now we are expecting like 8 or 9 interest rate raises from Fed. So this is something which really changed since then. Then, of course, another central banks, not just Fed, these monetary policy expectations around the world have followed this kind of hawkish repricing. And as well, these developments was like coupled with another additional 30% increase in energy and agricultural commodity prices on year-to-date basis, and with connection and together with rising economic risk from the Ukraine and Russian conflict, the question is, what are the markets signaling now? So is this kind of signaling some premature end of the economic cycle, or in what stage we are in the market? And our economists and head of tactical asset allocation colleagues thinks that the answer is no. They don't think that there should be any recession like sooner as it should be under normal conditions right now. They suggest that they see that market dynamics are kind of indicating some improvement in global growth expectation. And that's why they kind of repositions our view on tactical asset allocation. So what they did actually. In April, they increased risk in the portfolios, and they overweight equities relative to fixed income. And in equity space, they overweight mostly emerging market equities. And when you look in the perspective of factors or cyclical versus defensive, they overweight as well in this category than the cyclical sectors and factors. They increased credit risk from negative back to neutral after the last couple of months of reduction, and they moved to shorter duration and shorter maturity bonds. So you see this kind of you see this view that the increase of interest rates makes the tactical asset allocation heads to think about duration and to reduce then duration to lower levels, to buy more like shorter term bonds, to not suffer so much from the interest rate hikes. As I mentioned, maybe I can go into more details in case we have time for it. So as I said, so overweight equity versus fixed income, overweight emerging market versus developed market, going a little bit away from US, overweight cyclical equities versus defensive equities, overweight value factor versus growth factor, against small cap versus large cap, and in the credit, like more shorter duration credit, and on the bond side, more inflation-linked bond, and so on. But this is what our tactical asset allocation professionals are thinking about. But let's look at what are investors actually doing. So looking at the April industry ETF flows, which I discussed with you before, but looking now again at this in context of what economic specialists are thinking, there is still demand for global equity. So this is in line, actually, what investors are doing and what the professionals are thinking. Then the next move of investor is going to shorter term treasuries. Okay, this view is as well, investors are doing exactly what we think investors should be doing. And what we as well observed is this thematic topic like clean energy. So this is something, I guess, because of the Russia problem with the oil and so on, that Europe need to be less dependent on the energy from them, and that may be why now is this positive mood to go to clean energy, because Europe will need on the longer term basis kind of solve this kind of energy problem. What are investors avoiding are, of course, European equities and European monetary equities, and then high yield bond sectors and China equities and bonds.
Okay, thank you very much. So it seems, to sum it up, small caps, emerging markets, equities. So I guess we are in a good spot looking into our regional exchanges offering in terms of equities. And you mentioned also bonds and outflows in this asset class. It seems that the last couple of months were also tough here in Poland, especially. I mean, many investors, they learned in a hard way that bond funds are also subject to losses, and some of them experienced even double-digit losses during the last couple of months. And we saw significant redemptions from this asset class. So, leaving the tactical asset allocation for the moment, we saw in your presentation some global trends. And are these specific also when it comes to investors from our region, Central, Eastern European, Austria region, or is it we have as regional investors, being it institutions or individuals, some our own views on how to which underlyings to invest in.
Yeah, of course. Yeah, I mean, to answer your first question regarding bonds, as I mentioned a little bit about the tactical asset allocation, I will maybe just highlight that the inflation-linked bonds are really in favor at this moment because of the inflation expectation risk and the movement to shorter-term bonds. And this one we can observe in the flows that investors are investing currently in 1 to 3 years US Treasuries, as well as the whole European Govie space has negative outflows overall. But when you look inside into this category, that you see that the inflows in 1 to 3 European Treasuries are kind of positive in this regard, and as well in positive inflows in US corporate bonds, and still outflows in the credit because investors are worried about some credit risk. So outflows in high yield, and then of course outflows in European corporate bonds. So this is what we can observe from the data. Now your second question was what we see in our region. So I am responsible for Austria and CE region, so I can share with you what I see. What are the differences actually between CE investors and Austrian investors? And I see as well some differences between institutional investors and retail investors. But at this moment, I don't think that a lot of investors are doing a lot in CE, the tactical allocation. What I see is consistent flows in CE in these classic indices like S&P 500, MSCIs like MSCI World, MSCI Europe, MSCI Emerging Market, MSCI US, then in NASDAQ 100 indices. I don't see any like massive change in these flows in these from these CE clients. What I observed, which was quite obvious, was change of behavior in Austria. Maybe it's why that I can track better the Austrian number. I don't see much what's going on CE because it's difficult to get the information because everything is going via stock exchange, and the clients needs to call us and tell us, okay, we did this and we did that, so that we know it. So in Austria, I have better view. So a lot of institutional clients increased their gold exposure, mostly during the February after Ukraine invasion. And we saw as well more interest in factor ESG strategies in Austria. And we see very strong demand in Austria for like short duration ESG multi-factor fixed income products. This is less the topic for CE because in Czech Republic, for example, National Bank increased already the rate, so you can get on a cash account quite a nice sum, and I guess it's not so different in other countries like Hungary and so on. So that's why still in Austria and probably in other Western European countries, because of these low yield environments, there is demand for these short-term, short-duration corporate bond funds solutions in combination with ESG. In Austria, we can as well see a lot of demand for thematics, commodities, as I mentioned, and so on. So that would be in a nutshell what I can remember from the flows.
Yeah, thank you. That's very insightful. And staying with our local CE investors and ESG. You mentioned ESG during the presentation, and that Austrian investors are looking for such products. And how does it look like in a broader CE region? Because ESG, we all know that's the trend that will reshape the financial industry, I mean, asset management industry in particular. And do you see that trend picking up among our regional investors?
Yeah, thank you very much. Another excellent question. And you are very spot on these topics. And I have to say, To be honest, that in CE, not so much yet. I met a lot of clients in the last year. Even I was able to travel in September, October, August last year, and now I'm traveling again. And I had a lot of online calls with the clients in the CE regions, and talking with the as well institutional clients, as well fund of fund clients, and some platforms. ESG in CE region is not so in trend now. The investors they doesn't have to do something now, and they wait what will happen now. And the clients which are actually doing something, this one, they have some mother company in Europe which told them, okay, you should now do something about ESG in your portfolios. So, but what I can see from a couple of institutional clients in CE region, they already are moving a little bit, like slightly with small steps to some ESG benchmarks. And as you can remember, as I explained, between this light green ESG with small tracking error to dark green ESG with high tracking error. So what we can see in CE region, that the investors are moving more to the lighter green ESG indices with small tracking error and taking like a more careful approach. But then they are looking for some thematic investing. Then they will then create some position in clean energy or solar, or to have some satellite approach to that. But the situation is different in Austria, for example, and Western countries, where we have a lot of demand for ESG. And there's a lot of going on. Our biggest institutional partners and clients are completely restructuring the whole portfolios to ESG. So in the future, they will not buy anything which is not ESG. And this is a lot of kind of change in our industry. And we as Invesco, we had to adapt to this change as well to meet the demand of our clients. And we are very active of creating and launching new ESG products, as we did. I didn't count it, but in the last year, post 10 ESG products we created, and we are continuing these activities to meet the demand of the clients in Western Europe. So I think this is just a question of time when this trend will come and be more stronger in CE countries. This is something which is, I guess, not avoidable for the portfolio managers from the longer term perspective.
Okay, Eva, thank you very much. I've got a couple more questions, but being time conscious, I guess we have to stop here. So thank you very much for your time for this presentation and for this discussion. It was very insightful, and hopefully our viewers can utilize some of the information you provide us in their product and portfolio strategy for this year. So thank you very much again, and for our viewers, thank you very much for being with us for the last 55 minutes also. So thank you very much, and have a great rest of the conference.
Thank you very much as well, Michał. Thank you very much to you all.
Ladies and gentlemen, we are continuing Warsaw Passive Investment Conference, and now from a speculator to a small saver, how investors started making savings in the Warsaw Stock Exchange. We will hear from Michał Masłowski, who is the Deputy President of the Individual Investors Association. You have the floor.
Dzień dobry panu, witam państwa wszystkich.
Good afternoon, and first and foremost, I deeply regret that I can't be live with you now, and therefore I can't have these talks, informal talks with you, just to have this real glimpse of the conference. Should you be willing to invite me again next year, I'll be more than happy to join you in person, because I'm already it is enough for me of these online conferences. Individual investors have changed through the years, and from a speculator, a very aggressive figure, from a shark, has transformed into an investor that treat capital markets, the exchanges, the venue as a vehicle to save for their pension, and this is how they're adding up money to money, so they don't speculate, they do not turn on like various screens, and they are adding up sums of money saving. Small speculator, maybe a bit offensive, but this very saving in the long-term perspective is enormously difficult. To invest on the stock exchange, being active or passive, is simple, and as such, anyone who'd be, planting carrots or doing something else professionally can invest on the financial markets. It is possible and this is viable. So let's have a look at this journey from the 90s. What investors did look like then and what investors do look like now based on research that has already been conducted. But this is just something that this is just anecdotal in nature because this is something that I've been observing as I've been following the markets. I've been looking at statistical data. I've been talking with investors from the very early on, from the very 90s. Look at what investors looked like back then. I've decided to collect some pictures that actually provide you with certain impressions, certain insights into what the 90s looked like. The first session, 94, Bank Silesia, Bank Śląski did receive applications, many people did join in. I'd ask you a question if you recognize this room that you can see in the picture. This house is no longer existent. I can't serve you in this way. This is Universum building. It is my humble opinion that on the onset of the 90s, all stock exchange investors were speculators. Thanks to their strength, the market could go on. The market could kick-start. It was not possible in the neighboring countries, the Czech Republic or Slovakia. And the capital market is inexistent there, as opposed to Poland, where the capital markets are flowering. We like investing in Poland. This is a rule of the thumb. I'll be more broadly talking about it a bit later. All investors were speculators. This is my working thesis, and they were very much making up the turnover on the Warsaw Stock Exchange. The oldest data that I had at my disposal is from 1997. Those investors were making up 38% of all turnover. I believed it would be more. But this share of individual investors only started declining thereafter. There was this crackdown in 1994, then there was the rebound as something associated with the bull market, internet bull market. Then gradually, individual investors are declining, but they have not vanished altogether. We've got now the majority of corporate and institutional investors, and we are different to institutional investors. We do not have to invest when we've got the bear market, where we've got this side trend, as opposed to institutions. We may not invest. If times are interesting, then we awake and we return to the markets. So we are slightly advantaged vis-à-vis institutional investors as we don't have to be present in the market, but it is also changing. It has been changing. Throughout the last years, we have also been conducted research just to know, just to see how investors, individual investors, grown from speculators to savers. And this should be resounding in positive terms. We've been carrying out national investors survey. I'm not going to provide you with all the details about the figure of an individual investor, as it would take very much of our time. Still, I have picked up some facts just to underpin my thesis of having this transformation of a speculator into a saver. Point number one, as regards the major motivation why to invest in on the WSE, pension savings come as the first catalyst. Yeah, in the 90s, speculators did want to sell. We're not that willing to wait, and it is different now. Many people are thinking about their pension. So 25.1% has been a historic high, and this is the question that we've been asking our respondents since 2013. Beforehand, not many people were declaring they were willing to invest on the stock exchange. Then a U-turn came in 2015, and we know what happened in 2014. There was the second dismantling of the open pension funds. It turned out that some bonds disappeared. People got to know there were some installments to be paid. They won't get their pensions as they had expected. So investors started doing their thing, i.e. investing in the stock exchange. So 20-something% has been a multi-annual average. Now we have tracked direct high of 25.1%. This is how many people declared they would be willing to invest for their pension on the stock exchange. Secondly, size of wallet. And on average, we have almost 100,000 zlotys. This kind of structure may not be that telling. Those remarkable wallets are in minority. But let us look at how this shift has materialized. Smaller versus bigger wallets. Those who are bigger are gradually increasing. It is for the first time in history, those who declare they have almost more than 500,000 Polish zlotys are at a very high proportion, so we are getting richer on the stock exchange. And that's the last significant influx took place in 2010. There was a series of major privatization of major companies. Investors flowed in. There were new bits of equity in emergence. Years go on, wallets go bigger, and wallets go ever more diversified. And this is something that I'm going also to show you further. We used to be speculators, and towards the end of the 90s, there was a mass of investors that only had three shares of Bank Śląski. And later on, investors had as many as 25,000 in equities. So now shares are more numerous in single wallets. Those single wallets are more worthy, and if confronted with questions how many companies you've got in your wallet, there are different answers to be chosen from. We are planning on to have yet another range above 15 and more. One or two companies was the dominant response in the past. Now we've got 8 or more. So investors have established themselves pretty robustly. So in the past, we would have access to German market data. Poles have 8 or 9 companies, whereas the average for the German market is 20-something companies. This graph may be not so evocative, but look at what the evolution has been. Data of 2011, 11% only had 8 commodities or more. Now, this proportion is of 43%. So we are establishing ourselves as WSE investors. And we are also investing in dividends. This is yet another slide that has already surfaced because of Kamil. This is our data. What investors has in their wallet in 2021? This is the question that we've been asking for years now. Equity from WSE is 80 to 90%, and these two lines in red are mostly interesting to us. That is EFT funds, 33.7%, and one third of investors did reply that last year they had been in contact with at least one share of any ETF, and that means an increment by 13.6 base point. And this is a historic high that we are speaking about. And what's also been of importance, 26.9% of all investors did have in their portfolio shares of foreign vehicles, and this is also yet again a very significant increase. How can we know those who have shares at WC are no speculators? Rather, they are savers, whose group is now growing. This is also testified by answers to our second question, that is, what is the period of time that you are willing to hold your shares? We had 2020, 2021 inflows and outflows of the investors. This year, we've got 52.2% of investors surveyed answered they will be buying shares for at least a year. This is no speculation. This is something to be held. This is to be kept for a longer run. We are planning on to have an alternative question to ask the investors of whether or not they are buying shares for periods exceeding 5 years. Those who trade in and out, they are in minority, 2.5%. But that's the actual crux of the market. It is the case, but they will remain in the minority as this very task of speculation is extremely difficult. And this is something that we try to also raise awareness around. Speculation is hard, it is harsh, one has to have certain level of consciousness. Whereas investing for years should be something for everyone. So I'd like to convince you that that's actually the story. It was 1/4, 1/3 of investors who were buying shares for at least a year. Now, this proportion has risen to more than 50%, as seen on this slide. The same question also was asked to investors that once declared they would have ETF funds in 2021. And the answer is obvious. Investors do not buy ETFs to speculate, and they do it by virtue of having them for eternity. So 80% of investors did declare they would be buying ETFs to have them for at least 1 year. And it is seen, it is more than evident. And let me reiterate what has already been said. So we are transforming from speculators into savers. We are now the ones who save, who buy for a longer period of time, as we want to have our dividend paid off. Sad, I've been following the market quite closely. In the 90s, we only had speculators. Just look at interest rates, 20% something. And we are slightly returning to those times. Unfortunately, all the actors were speculators, essentially, because they wanted to have decent earnings. The market has changed. If I wanted to describe the investor as a figure in the period of 2008 to 2020, when companies started sharing their dividends with the investors, it would be like this. In the past, it would be very uncommon for companies to pay off dividends. Later on, they came along in larger numbers, and this is something, and more and more companies are following suit. Therefore, these individual investors of 2013 and 2020 can be described by a vehicle of having these companies in mind. Firma, our Wrocław company, has been paying dividend quarterly since 2016, as Coca-Cola, Procter & Gamble, and other significant American players do. These noble dividend companies. There are other companies that replicate this model. These are just the ones that I could come up with. So we've got this dividend offer, and thanks to the recent efforts, this ETF offer has been growing. So we can buy ETFs for Polish indices or for American indices here locally on WSE. And now, if I were to tell you something more about what investors are like in 2021, 2022, something has changed in the meantime. So we've got these dividend companies on the one hand. On the other hand, we've got ETFs that have already been listed on the Warsaw Stock Exchange. Plus, we've got robo-advisors, Finax and Thematic Ion have been something pretty new. An investor should pursue the following path. Short-term speculator, shorter-term, longer-term dividend up to the level of robo-advisors. But it should be quite the reversal. First, robo-advisors, then, with experience, investors should be guided by more risky ventures. And there is one new trend that we have seen, that is foreign investment. First and foremost, it is very much owing to the development of technology. Costs are also declining, are decreasing, and so foreign markets opened to us. This is not like pre-2021. Investors did not invest in foreign markets, but it was not as common. Yes, indeed, we are now buying shares of American companies, plus we are also buying ETFs for the foreign markets. So we've got access to them. We do have access, and there is one go-between, that is a major Polish brokerage house. So it has been sped up. And just one remark to wrap up. This trend of foreign investing has been crystal clear, and it has been accelerated by the outbreak of war in Ukraine. We like our home capital market. It is well matured. We love City Project and other companies because we've got this capital market already in place. Still, the war in Ukraine has been a kind of awakening for the Polish investors to something of an encouragement for them to invest internationally. Because we need to be also imagining ourselves as if we were Ukrainians, i.e., we need to be doing something else. We need to be investing internationally. So we have been trained at a very fast pace how to invest on international markets. If it hadn't been for the pandemic, we would have landed at a place where we are now, but after a slightly longer period of time. And the pandemic has sped up certain trends, i.e. remote work. And likewise, we'll be buying now shares of international markets. It was not the case in the past because people were more keen on investing on the home market. Trends have shifted. and this trend will ever accelerate despite any barriers, be it linguistic or others. I will wrap up there. From speculator to long-term saver, very much oriented versus dividends open to foreign markets. This is something that Poles are keen on, so that has been basically the shift of investors throughout the last 30 years.
Thank you very much. And I now hand over back to the conference. I wish I was there. Hope I will be there next year. And we will hold you to it. Thank you from the president of the Individual Investors Association. We now have Mateusz Mucha, who will have a presentation. He is the manager from Beta ETF. Why Warsaw Stock Exchange is an attractive place to make money. Thank you. Well, this will be the last presentation in the course of this two-day conference. A big advantage of the conference has been that practically all of us could find something for themselves. We've heard discussions about the capital, the equities market. It should be interesting to politicians, to stock exchanges managers, to investors. We've heard about the ETFs, how they are changing, how they are now used by institutional investors. We've heard from individual investors' point of view. And we could wrap up, but there is one very important group that hasn't been mentioned, the largest group, the people who are not yet investing in the Warsaw Stock Exchange. And we should think about how to prepare something for them. And hence this presentation to show why the Warsaw Stock Exchange is an attractive place to multiply your assets. To answer this question, we should ask ourselves about the vision and the image of the Warsaw Stock Exchange. Is it good? Well, unfortunately, it is far from the developed markets. To many people, a stock exchange is something like a gambling house. It was even mentioned by the president of the Polish central bank, which he then retracted. But he did say that, and many people remember that. People think that you need a lot of time, a lot of money, a lot of knowledge to invest in the stock market. These are the associations in the minds of many people, and they put you off from taking the jump into investing in the stock exchange. To change this image into the one where you can successfully multiply your funds, we need to put in a lot of work and convince the ones who are not yet convinced that WSE is a place where you can increase the value of your funds. And also to answer this question, we should consider the fears. Why people are not investing in the stock market? Well, because they don't have enough knowledge, because they fear losses, and we don't invest because we feel we don't have enough money. So, in this presentation, I will want to address these three major fears and dispel them. Obviously, these fears are quite natural, but today's offer of the Warsaw Stock Exchange, especially in terms of the ETF, addresses these fears and may help dispel them successfully. I hope that in the subsequent editions of the Warsaw Passive Investment Conference, this ratio of 80% people who do not plan to invest individually will drop down considerably. As far as the financial competence is concerned, obviously you can go and study finance, and you can read economic and financial materials and learn a lot about what is happening and what the developments are. But for a person who is not professionally connected to these areas, it's simply impossible to monitor what's going on. They have their own lives, they have their own specialities. If you have a job and you have one source of income, you sometimes just want to park your money, to protect your money from inflation, to ensure your kids' future, to protect your entire retirement pot. You don't have the time to get involved seriously in the financial knowledge. But in fact, you don't need that knowledge. You need to stick to three simple, fundamental rules. The first one is diversification, compounded interest, and liquidity. Diversification is the most effective method of managing the risk, and that is how you can protect yourself from your own ignorance. Compounded interest is the best ally of an investor in the long term, and liquidity is necessary so that the financial assets that you locate in the stock market have accessible whenever you need them. ETFs and the passive investment development, which also is happening in Warsaw, is the investment tool which meets these three fundamental principles. Let's start with diversification. To buy a winning share that will make us millions is obviously the dream of everyone. You know these stories. You know, someone purchased the Coca-Cola shares decades ago and made a mint on it. But it's always very hard to find such a company. Obviously, there are these prophets, advisors who tell you this is the future, invest in this or that. But the truth is that the results from the past is not always the guarantee for the future. And you will, apart from those hugely successful companies, you will see those who slumped. So from the point of view of a future investor, a person who doesn't have time to study finance, the proper attitude is diversification. The more shares you have in your portfolio, the more protection from the loss of your capital. The diversification should be understood broadly. You diversify among your shares. Michał Masłowski said that we used to have 3 shares in our portfolio. Now we have 8, or many people have much more. But thanks to the ETF, you can have 500 shares in your portfolio. And that's how it should be understood. Rather than holding just a couple, you can hold hundreds. Also, sectoral diversification, banks, real estate, healthcare, this is all a possibility. Also, asset classes. If some classes are too risky for you, you shift the assets into bonds, for instance. So diversification is something that is easily achievable through ETFs, and that's why WSE becomes an attractive place to multiply your assets, because through one transaction you can build a diversified portfolio. A big challenge is often the conviction that a lot of money is needed to invest in the stock market. We believe that even when you have 1,000 and devote 1,000 zlotys per year, it is already enough to purchase certificates or ETFs which are listed in the Warsaw Stock Exchange. So the barrier to investment, the threshold is not very high. It's enough to have 100 zlotys per month, so you can have a little more than 1,000 per year, and that can already be a reasonable start for your investment. The WSE offer now can give you exposure to over 600 companies, WIG20, WIG40, WIG80, WIGTech. These are the Polish ETFs. We have Nasdaq 100, S&P 500, which includes 500 biggest American companies, the German DAX, and a new class of assets, the first ETF for treasury bonds. An example of diversification of S&P 500, which you can see in the right-hand bottom part, it shows you a huge advantage of this transparency, because the investor at each and every moment can check how his exposure functions geographically and in terms of sectors, and it only helps the investor to manage his portfolio well. This is quite a new solution. A few years ago, investors didn't have that opportunity, but the investing democracy has come, and now the investors can benefit from these tools. And the long-term horizon, only one thing is certain, it's the changeability of the sectors and of the indexes. You can see an example, a 20-year difference between the 10 biggest companies in the S&P 500 in 2002 and in 2022. You can see how hugely this has changed. In Warsaw, you can sometimes say, let's invest in the biggest company, for instance, CD Projekt 2 years ago, or a big bank, but because we think we know this company. But to be honest, when you think about a 20-year investment horizon, there's no way that you can foresee that the big company today will be a big company in 20 years' time. And you can see that in S&P 500, how it has completely changed. Top 10 in 2002, only one, Microsoft, has remained in the top 10 in 2022. In VIG 20, over the 17 years, quite an impressive change as well. Only 4 companies have remained in the VIG 20. Obviously, a bit more because it's just 20 companies. So if you want to bet on the larger caps, it is just taking a big risk, a specific risk with just one particular share. But an investor who has no time following the financial markets simply should not make such a huge risk on one or a couple companies. It's better to purchase an index which will reflect the changes. The indices and ETFs which track them have the advantage that they simply increase the share of the companies which grow, and the ones which are on the wane or grow at a slower rate will have a smaller weight. So an investor via the ETFs is exposed to the global changes which he's not able to foresee on his own. And to give you some examples which demonstrate how the changeability transpires in the long term, the share of different sectors in America in 1900s and 2019. I wish that you had this investment horizon of 100 years, but this is just to give you an example how things are changed over decades. Only one thing is sure, changeability. Who knows what sectors will dominate in another 100 years and what financial markets will be dominant. Today, when somebody starts investing in the stock exchange, can be sure that America is the hegemon. They dominate 50% of the global financial market. But it has not always been the case. So the question remains open, will it still be the case in the future? So it is always better to diversify your investment portfolio with that in mind. Another important feature of successful investing is the compounded interest, a crucial element which helps multiply your assets. And that results from 3 factors: the result of the investment minus the cost of investment times the time of investment. The time of investment, especially when you're saving for your retirement, is a huge asset. And this determines the rate of return, the compounded interest. Investors focus on the control of the results, which is understood because when you read financial papers, you see the headlines, rate of return, something grew 20%, or another company dropped 30%, someone made 400% in a year. And these figures are sometimes very striking, and you start thinking how much I could have made. You don't see the risk element. You look at the investment from the result that somebody made 10%, but you don't take into account the risk. Investment results are not controlled in effect. No one can guarantee how much you will make in 5 and 10 years' time, because if we knew that, we would be there. There are lots of views in the world of finance, lots of advice, and observing such a discussion from the standpoint of a simple investor is unfeasible. An investor should limit the costs of investment, and that is something that you can focus on. The ETFs, the passive revolution in the market is definitely helping in that, because the cost of investment have considerably dropped. The investor incurs much lower cost than they had to incur 5 or 10 years ago. In terms of investment results, let me pick up on what Kamil Szymański said. The indexes have a certain general trend. In the long term, they give you a higher return than most active investment solutions. Kamil gave us an example of foreign shares. In Better Securities, we analyzed the Polish market, and these trends are also visible. In SVIC 80 TR, we had 94% over 10 years. That is just an example. MVIC 40 TR, 97%. This shows you that an individual investor, the one who may not necessarily have huge financial expertise and has no time to monitor financial markets, can obtain high investment results in a given class of assets. He can obtain better results. That is quite real. Also in treasury bonds, TBSP index, you can see 93% return over a 10-year investment period. Costs of investment. Fees and charges. That is an important aspect which is often overlooked by many investors. If we compare the table, the bottom left-hand corner, the difference between the Polish obligations with the ETF has not 0.% fee, and the active fund has 1.15% fee, management fee. Well, some people say, well, 1% saving, what is it? It's not such a big deal. Perhaps it is better to pay this 1% more. But the reality is that the investment costs are only seemingly small. If you capitalize them in the long-term perspective, you will see that you have lost a lot of money. So if you take the 1,200 zlotys from the previous slide, if you invest that for 40 years with an average annual return of 5%, an investment with 4% return gives you this result. So you get the return of 96,000. You have 2%, the income drops to 48%. So practically, you gave up half, almost half, by only giving 1.6 percentage points in annual charges. For 40 years, you practically have another amount like that. You paid 48,000 in fees. For those who are not yet investing in the Warsaw Stock Exchange, it is worth considering another aspect. It is worth packaging your account in tools like IKE, which is an environment fund. These are the tools which help you save on the income tax when you meet certain conditions on long-term investing. There are two advantages. First, this account supports you for long-term investment. And you can hold 100% of the profit. In S&P 500, if you invest in IKE, in 2011, were the first ETF was launched, and you can see that you obtained 29,000 zlotys profit. If you invest the same amount without the IKE tool in 2022, you would have to give up over 5,000 zlotys in tax.
Przyszłego zagospodarowania, jeżeli tylko byś.
So this is a tool worthwhile considering, and here in this slide we see that most investors do not use this tool. We've got more than 20 million people who are entitled to use the IKE tool. Just some percent do take advantage of it, and for brokerage accounts, this proportion is even slighter. Then duration of investment is something also worth considering. The sooner we invest, the greater the final outcome. And I'm delighted to also get in touch with the younger generations. Some of my counterparts do declare they want to invest in themselves in the first place, because we know qualifications we need to obtain. Investing in ourselves is always something that is worthy of considering. There's a great strategy, nevertheless, from the point of view of the capital market, from the point of view of pension security. This doesn't come without its cost embedded. If you invest from your 20s, 1,200 5% premium will get you 212,000 Polish zlotys in your retirement age. But younger people say they don't invest now because they will be getting more now in remuneration and they will be saving afterwards. So let's check if somebody saves 2,400 zlotys from the 35th years of age, they will be somewhere in the middle. They will never catch up with those who started early in the 20s. So if we decide on investing ourselves, be mindful of the fact time is passing and is playing very much to our disfavor. The sooner we start acting, will play ever more to our favor. Many investors wait for the moment to invest. Recently, we've seen 14 or even 15 sessions in decline. And there is this temptation which comes immediately. Okay, I'd better wait. I'd better see and wait for the moment to come. Then there is this rebound. Then the further drops. A year has passed as we have been undecided. So waiting for the moment for an investment, especially if we are interested in saving on the stock exchange, is absolutely pointless, because a moment in time is not as significant as the very duration. Look at the example of investing in S&P 500, 10,000 in investment. This investment is concluded with over 39,000. 10 best session days, if they are excluded, we've got a total of 21,000. 10 session days from the very period of time of 2,728 days. This is just a fraction of it all. And look, this notwithstanding how much impact it exerted on the final outcome. There is no way we predict whether or not the markets are supposed to be growing. This is beyond our capabilities. This is beyond capabilities of both institutional and individual investors. Let's be with the market. Let's invest on a regular basis. Let's diversify equity, bonds. Let's save on a regular manner, and that's the way for you if you want to multiply your affluence on the stock exchange. If you wait, then also high, you'll bypass as a secondary product those most lavish session days. Liquidity. Now, ETF on WSE in this context. ETFs here are most liquid because they use S&P 500, Nasdaq 100 or DAX and also WSE is characterized with very vast liquidity. Others are less liquid still from the standpoint of an individual investor who can collect as many as a few thousand Polish zlotys. This kind of liquidity degree is of sufficient character to feel safe. The foundation of liquidity is always at assets. But the very construct of ETFs is very much about transparency, also in the topic of liquidity. We see the manager of the fund; they are obliged to be trading in and out in a continuous manner, and this has to be disclosed. So the offer of at the Warsaw Stock Exchange provides you with diversified, transparent, and liquid investment vehicles, which can be taken advantage of for multiplying your assets. So diversification, low costs, and liquidity is something that boils down to the investment strategy. This investment strategy should be defined. In order for it to be defined, risk needs to be assessed. Whether or not we are inclined to go on with this risk. And exchange indices can help us out here because they are here to illustrate what our investments can fare in the future. So let's have a quick look at 3 investment strategies, just examples, not copy them. Just use it for your own purpose. Let's look at them more closely. We've got a conservative strategy, 80% with treasury bonds. Our investors that are afraid of risk, market and equity volatility, therefore they are more keen to invest in more conservatively. 20% exposure to equity, 15% for S&P 500, while 5% remains with beta EFT on VIX 40 TR. Mixed attitude is about 50% in treasury bonds and displayed as follows. And there is one more extreme strategy. This is a hawkish, aggressive strategy, 100% based on equity. Such a portfolio can be well checked out thanks to the stock exchange and sessions. This is the graph presenting how 10,000 zlotys fare throughout this period of time. Equities helped us earn the most. Equities can get you most money on the financial markets, of course, and this is also tantamount to most significant financial risks. Still, both mixed and conservative strategies also were vehicles to outperform inflation highs. All strategies are feasible in terms of the ROI. Now, look at ETF. It's fully transparent, therefore investors can assess their own financial risk. This transparency also is a vehicle to monitor the risk in terms of daily decreases. 2.5% was the deepest daily drop. In terms of most hawkish strategy, this deepest drop was at a level of 10%, more than 10% below. Can I slip with it? Can I count it in? If yes, let's have this wallet. If not, let's have assets that would mitigate this risk altogether. So this is the kind of control that investors should use in order to navigate through that investment portfolio. So we based on diversification, cheap costs, and other factors, and therefore ROI can be eventually very attractive, and assets can be further expanded on the stock exchange. Thank you, Mateusz. This was Mateusz Mucha speaking. Thank you for these insights. Ladies and gentlemen, that was the actual conclusion of our Warsaw Passive Investment Conference. We're saying goodbye. We are happy still, as we are very hopeful to meet you again in greater numbers next year.